clear, be passionate,
Yes.
and most importantly, be you.
Thanks a lot. It's great to
We
see
can't
you.
wait to see what you've got. Let's get funded now.
It's tough to get those guys out of DC. They have a great snack area down in our DC office. It's tough to get those guys out.
It is actually top notch. I think the gym. All right, Nathan Dean, Bloomberg Intelligence Senior Policy Analyst. We really appreciate it. Thank you very, very much. All right, more coming up on Bloomberg Intelligence. We're going to go back to the Fed. Ira Jersey's also in the city. You're right. There must be something happening.
Something going on.
Bloomberg Intelligence Senior U.S. Interest Rate Strategist. Because if you wrap in what we're seeing in D.C., how's the reaction function to the Fed really going to match policy that is very much unknown? This is Bloomberg Intelligence.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. I'm Charlie Pellet. The U.S. Supreme Court says it will hear TikTok's challenge to a law that would ban the social media app if it is not sold by its Chinese parent company, scheduling arguments for January 10th. TikTok and ByteDance, the owner, say the law violates the Constitution's free speech protections. A federal appeals court in Washington upheld the law earlier this month on a 3-0 vote, saying Congress was legitimately acting to protect national security and user privacy. Stocks higher as investors await the Fed decision, 2 o'clock Wall Street time. We got more on that coming up in a moment with our Ira Jersey. S&P up 12 now, a gain there of 0.2%. The Dow up 143, up 0.3%. NASDAQ up 44. That is a gain of 0.2%. 10-year at 4.39%. The 2-year 4.22%. Spot gold down $11 the ounce, down 0.4%. West Texas Intermediate crude up 1.6%, 71.23 a barrel, and Bitcoin now down 2.2% at 104,000. The Commerce Department out with mixed numbers on America's housing market, and with that story, here's Bloomberg's Vinny Del Giudice.
A slowdown in apartment construction sent November's housing starts report into a spiral. The 23% drop in apartments offset an increase in single-family homes, an increase stemming mainly from hurricane recovery in the South. Meantime, weekly mortgage industry data show an increase in loans for home purchases. Loan refinancing was down. Looking ahead, Thursday we'll get data on sales of previously owned homes. Vinny Del Giudice, Bloomberg Radio.
And among home builders, Lennar, which reports after the bell today, up 0.3%. Toll down 0.6%. KB Home down 0.1%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. And that's a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Alex Steele and Paul Sweeney, we are live with you in our Bloomberg Interactive Brokers studio in New York City. We're also streaming live on YouTube, so head over to youtube.com. And that's where you'll find the video of this program. You can go search Bloomberg Podcast, and that's where you'll find us. Fed Day today. We'll have complete coverage this afternoon starting at 1:30 p.m. Wall Street time with Tom Keenan and the surveillance crew, simulcast on radio and television, take you right through the 2:30 press conference. Let's check in with someone who actually gets paid to think about this interest rate stuff. I can't believe you built a career around that, but people do. Ira Jersey, Chief U.S. Interest Rate Strategist, Bloomberg Intelligence. He joins us here in the Bloomberg Interactive Broker Studio. It is that time of year when people come in from Princeton and other locales because there's Christmas parties and stuff like that. People are buying drinks for other people.
I avoid those things.
But that's what brings these folks out of the woodwork. We had the Washington crew, Nathan Dean, and Matt Shelton-Helm. Now we got Ira Jersey. Ira, what should we be looking at or listening for from Fed Chairman Jay Powell this afternoon?
Yeah, so the number one thing is he less dovish than he had been during the previous couple of meetings? Because the market certainly thinks that the Federal Reserve at this point is going to cut now, but pause in January and then cut again in March. So if he sounds either a little bit more dovish than that, more like he did in November, then the market will react to that. And I think that there's kind of going to be this weird reaction if that does happen. One is short-term yields will rally a little bit, so they'll go down, right? So things like Fed funds futures, SOFR futures, and 2-year yields. But the market's going to say, hey, the Fed might be making a policy mistake here because the economy's pretty good, retail sales were okay, we're still growing jobs, and, wages are still going up. So all of those things combined might suggest to the market that the Fed is making a policy mistake, inflation will go up, so you wind up seeing 10-year yields, 30-year yields sell off a little bit, and yields go a bit higher.
Skip, pause, or hold. Is there a distinction in your world among those three things?
No, I don't, right? I mean, a pause or a skip is definitively the same thing, right? It's just saying, okay, look, we're not going to be cutting now, but we're going to cut at the next meeting. Jay is going to continue. Jay Powell is going to continue.
Yeah, so
that's out
there. It's going to be, we're sitting around a desk, so it feels very natural. So I do think that Fed Chair Powell is going to sound, still leave his options open, right? He's still going to say we're data dependent, we're making decisions meeting by meeting, but I suspect that he's going to add in like a little phrase here and there, being like, given the incoming data, if the incoming data is like it has been in the past, then it might be time for us to slow the pace of cuts. Right, that would mean that you have, in order to slow from the pace they're going now, they would have to skip a meeting, right?
But a skip, not a pause. Because a pause would imply like a longer period versus like a one-time skip. The market's going to be reading into that stuff.
Maybe, yes, and we parse every word, and we probably parse it too much. But I do suspect that if he says something like that, then that's going to mean 100% chance that they're not going to cut again in January. But then I think we'll still probably price for another March move. And obviously we get the dots too, right? And one of the things that I think has been missed over the last couple of meetings is that when you look at the long-term dot, right, which people say is the neutral rate and the Fed's estimate of neutral rate, I'm not sure that that's really what it is. But what you've seen the last couple of meetings that we've gotten the dot plot, that they're starting to move higher, right? They're moving that long-term dot higher. And if you use the function on the terminal dots go and go to historical, you can see how this was basically at the same level at this 2.5% median dot for the longer term for 5 years. And only in the last couple of meetings have they started, in June and September of this year, have they started to increase them. And I think that they'll go up even again, because I think it's pretty clear that interest rates don't matter as much to this economy as they did 20 years ago, 30 years ago, just because the structure of the economy's changed quite a lot.
But don't we have like a bigger debt? And we have to worry about that and financing that and refinancing that?
Well, we do, but the Federal Reserve's not going to cut rates just so, the federal government and the taxpayer are going to save some money, right? They're doing it because their mandate is not, debt sustainability. Their mandate is low inflation and full employment.
Good point. And this historical part of this function, I didn't even know it was there, so it's very cool. See, I learned something new today.
That's good. We like that.
Yeah, absolutely.
So when you we talk about how the economy is not as sensitive to Fed hikes or cuts, where is that coming from?
Yeah, so if you think about the structure of the economy, right, prior to the year 2000, about a third of all corporate debt was in commercial paper, right? So things that were very sensitive to short-term interest rates. Now it's not zero, but it's under 10%, right? So it's very limited, how much debt is being used for short-term financing. The same thing or a similar thing happened to the financial institutions during the global financial crisis, and now households are less sensitive to interest rates because everyone refinanced their mortgage during, when we were at zero in 2021, 2022, before the Fed hiked rates, right? So you don't have the household sectors not as sensitive to interest rates either. Those couple of sectors that are sensitive, like, autos and a few others, are being hit, but that's still a relatively small part of our economy overall.
Is our 10-year, should we expect it to be in some kind of range bound? It just feels like that. I've been quoting this 4.4 number, multiple times a day for seemingly forever.
You don't buy the 6% by T. Rowe price?
You mean the 4.35 where we were on Monday was?
We do this every day.
Yeah. So yes. So I suspect, and I hate to tell you, Paul, that I do think that that 10-year Treasury yields are probably going to be range bound. Narrowly between 4 and 4.5%, more broadly between basically 100 basis point range. Maybe with 4.7% being the upper bound. But that's not unusual in a situation where, hey, the Fed's cutting interest rates still, right, even if it's going to be slower than we had thought 6 months ago. But at some point, they're going to have to raise interest rates again, right? And look, the Fed funds rate after today's cut is going to be at the same rate as the 10-year. So this is going to be the first time that the overnight to 10-year curve is not inverted for the last 2 years, right? Think about that. Right, so this is going to be the first time that we have a flat overnight to 10-year curve.
Wow, that means something.
Well, it means that the Fed's cut rates, right?
Yeah, but that's got to mean something. It's a moment.
Well, it also means that the market doesn't expect over the next decade, right? Like if you think about what the 10-year rate, generally speaking, unless you think that we're really in for a default in the next decade, which I don't think most people think is realistic. It's just an expectation. What do we think that the Fed funds rate is going to average over the next decade? And basically, it's 4.4%.
Where we are.
Right, Paul?
Yep.
Really, really great to see you. Always a pleasure. Ira Jersey, Bloomberg Intelligence, Senior U.S. Rates Strategist. Well, lovely to see you.
I don't think we're going to see him in the week before
No, I
Christmas
know.
and
That's
New
why it's
Year's.
so nice to see him right now.
No, I'll be in North Carolina with my folks.
See, there you go.
Yeah, there you go. All right, we are taking a look at this market as we wait for the Fed in just a few hours' time. This is Bloomberg Intelligence. Happy Wednesday.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Wednesday, happy Fed Day, happy Hump Day. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio, and you can find us on YouTube as well. We are live from Interactive Broker Studio right here in Midtown Manhattan. Every day, we talk about the Bloomberg Big Take. We plug it every day. It is an in-depth story, either of finance or economics, individual companies, hedge funds, private equity, that give insight that only our Bloomberg News team.
The analysis is called Tired of Buying Dollars, but Not Confident Enough to Buy Euros.
Okay.
So, we're going to break this down, and we're going to see if the euro actually has a shot.
That's good.
Right. So the euro, it took a hit back in October, November.
Yeah, it did. It's been kind of stuck ever since then.
Stuck how? Sometimes I feel like these financial terms, they're just a whole other language.
Yeah.
Yeah.
No, I hear you. Think about it this way. If you were looking at a chart of the euro's value,
Yeah.
instead of seeing this steep drop, it's been trading in a narrow range. So it's almost as if it's taking a breather
Okay.
before it decides, what its next move's going to be.
Okay.
That's what we call a sideways consolidation trend.
Okay.
But the key thing here, the key thing to look out for is whether it can break above that downward trend line.
So it's almost like it's got a hurdle to jump over.
Exactly. It's eyeing that hurdle.
Yeah.
And if it can clear it,
Yeah.
we might see a real rally.
So where is this hurdle? Where are we looking? What do we need to see?
Well, the article highlights 1.0628
Yeah.
as a critical level. So if the euro closes above that number on a daily basis,
Okay.
it could be a signal that the momentum is shifting. So think of it as a green light
Got it.
for potential upward movement. But even if that happens,
Right.
it doesn't guarantee smooth sailing from there.
Okay. So it's not a guarantee, but it is something to watch.
Absolutely.
Okay. There's something else I want to talk about. The article also mentions
Yeah.
the market seems tired of buying dollars, but is not yet confident enough to buy euros outright.
Right. Right.
So what does that actually mean for someone like me? You know, I'm trying to make investment decisions. What does that actually mean?
Well, it's all about psychology.
Okay.
Remember the Trump trade.
Yeah.
That optimism after the election,
Right.
the dollar was soaring.
Yep.
It's starting to fade. And the dollar's power is waning with U.S. interest rates staying low.
Okay.
But here's the catch. Investors are still pretty down on the Eurozone. So they're a little bit hesitant to fully embrace the euro, which suggests it might be undervalued.
Okay. Undervalued.
Yep.
That sounds like an opportunity.
Potentially.
But I do have one concern. The article also mentions
Yeah.
there was some political drama in France.
Yeah.
There was that no confidence vote against the government.
Mm.
Did that impact the euro?
It caused a little bit of a stir.
How so?
So France issues bonds called OATs.
Mm.
Think of them as IOUs from the French government.
Okay.
When that political uncertainty spiked, investors got a little bit nervous.
Yeah.
And they started selling those OATs, which put some pressure on the euro.
So politics and economics, they're all kind of tied together.
Very much so.
But the article did say that that selling stabilized.
Yes.
So are we in the clear?
It seems like for now, it seems like the markets are looking ahead to new elections in France in mid-2025. So the panic has subsided a bit.
That's good.
And here's something that might surprise you.
Okay.
Even with all of that drama, French bond yields are actually at their lowest point since early October.
Wow.
That's a sign of resilience that we
Yeah.
shouldn't overlook.
So even amidst the political turmoil, it sounds like there's some glimmers of hope.
There are.
What else should we be paying attention to? What are the other factors at play here?
Well, this week, everyone's going to be watching the European Central Bank,
Okay.
the ECB. They have a big meeting coming up.
Okay.
And the question is, will they cut interest rates again?
I'm already on the edge of my seat. What are the chances of that happening?
It's a big question. The general consensus right now is that they'll cut rates by 0.25%.
Okay.
But some analysts are predicting a bolder move of 0.50%.
Wow.
Either way, cutting rates tends to weaken a currency.
Can you explain that?
Yeah. So think about it this way. Lower interest rates,
Okay.
they make it less attractive to hold that currency. So the demand drops and its value dips. This would likely push the euro down against the dollar, lowering the euro-USD exchange rate.
Okay. So if the ECB cuts rates, the euro could weaken.
It's a possibility.
But I remember the article mentioned some conflicting opinions.
Yes. There are some economists
Okay.
who believe that the ECB should hold off
Okay.
on cutting rates this time.
Interesting.
They argue that keeping some ammunition in reserve in case things get really bad
Yeah.
could actually strengthen the euro in the long run.
Interesting. So it's about sending a message of confidence.
Exactly.
Okay. So even the experts don't really know what's going to happen.
It's a tough call.
What about over in the U.S.? What's going on over there that could impact all of this?
Well, the U.S. has its own set of factors to consider.
Okay.
We got a decent jobs report recently,
Okay.
but all eyes are on the upcoming inflation data,
Okay.
and that could really shake things up.
Why? Why is inflation data so important?
Because this particular inflation report is the last major piece of economic data that we'll get before the Federal Reserve
Oh, Fed.
makes its interest rate decision on December 18th.
So it's a big deal.
Very big deal.
Okay. So what are the scenarios? What should we be looking for?
So if inflation comes in higher than expected,
Yeah.
it might make the Fed think twice about cutting interest rates.
Yep.
Because remember, one of their main goals is to keep inflation under control.
Right.
And if they decide to hold off on a rate cut,
Yeah.
that could actually boost the dollar.
And if the dollar gets stronger, that would probably push the euro down.
Does he seesaw?
It is a lot to keep in mind.
Yeah.
This is complicated.
It's a balancing act.
It is. But that's the nature of the global economy, I guess.
Everything is connected.
So what does this mean for someone like me?
Well,
I'm trying to make sense of the markets and
Yeah.
make good decisions.
That's where things get really interesting.
Okay.
We'll dive into that in part 2.
Okay. Sounds good.
It means you got to stay informed and recognize that things can change quickly. There are definitely some potential upsides for the euro,
Yeah.
especially if the ECB makes good decisions and if that US inflation data comes in lower than expected.
Okay.
But on the flip side, things could go the other way
Okay.
and the euro could weaken further.
So no guarantees.
Right.
But sounds like there's potential.
Yes.
So we've got this wait and see situation with the euro, some hints that it might be undervalued.
Right.
We have the political drama in France. But thankfully, it sounds like that's starting to settle down.
It does. And remember that detail about French bond yields?
Yes.
Despite the political shakeup, they're actually at their lowest point since early October.
Right.
That suggests a level of resilience in the French economy.
Yeah. A lot of people might not know that.
Right.
It is fascinating how these little details can give us such valuable insights.
Absolutely.
And that's what I love about these deep dives. We're
Yeah.
not just skimming the surface.
Right.
We're really getting down into it.
Exactly.
Okay, so let's go back to that ECB meeting for a second. We've talked about them potentially cutting rates.
Yeah.
What are the arguments for and against that?
Good question. So the main argument for a rate cut is to try and stimulate economic growth.
Okay.
So when interest rates are lower, it becomes cheaper for businesses to borrow money and invest.
Okay.
And it also encourages consumers to spend more.
Okay. So it's like a little caffeine boost for the economy.
Exactly.
But wouldn't that also come with the trade-off of a weaker euro?
Well, that's the big question that the ECB is grappling with.
Yeah.
Some economists argued that a weaker euro can actually be beneficial in some situations.
How so?
Well, think about it. A weaker euro
Okay.
makes goods and services that are produced in the Eurozone cheaper
Yeah.
for buyers who are using other currencies.
Right.
This could be a major advantage for export-oriented industries.
So there are some potential upsides,
There are.
but I imagine there are some strong arguments against cutting rates as well.
Oh, absolutely. One of the biggest concerns is inflation. When a currency weakens, imported goods become more expensive.
Right.
And since the Eurozone imports a lot of goods, a weaker euro could push up inflation.
Yeah, that makes sense.
And remember, the ECB is tasked with keeping inflation in check.
Yeah. You got to walk that tightrope.
Exactly.
Okay. So what's your take? Do you think they should cut rates or hold off?
Well, I'm not in the business of making predictions,
Okay.
but I can tell you that the market is already pricing in a rate cut.
Okay.
So investors seem to believe it's a likely outcome. But as we've discussed, there are valid arguments against it.
Right.
So the ECB could surprise us.
It's a game of chess.
It is.
It really is.
They're constantly trying to anticipate each other's next move.
Okay. Well, speaking of global factors, let's talk more about the U.S.
Okay.
We touched on that upcoming inflation data
Yeah.
and how that could impact the Fed's interest rate decision. Can you walk us through that?
Sure. So the Fed is currently in wait and see mode.
Okay.
They're trying to get a sense of how the U.S. economy is doing. Before they decide whether to make any big moves, they've already cut rates twice this year.
Okay.
So the question now is, do they keep cutting or do they take a pause?
And that's where the inflation report comes in.
Exactly.
Okay.
If those inflation numbers come in higher than expected,
Yeah.
it could be a signal that the economy is overheating.
Okay.
That might make the Fed reluctant to cut rates further.
Okay.
But if inflation stays tame,
Yeah.
that gives them more leeway to potentially cut rates again.
So it's a bit of a nail biter.
It is.
We'll just have to wait and see what those numbers look like.
We will.
But it sounds like whatever the Fed decides, it's going to have a global impact.
Absolutely. The US and the Eurozone are two of the biggest players in the global economy.
Yeah.
So their monetary policies are closely linked. If the Fed cuts rates, it could weaken the dollar,
Okay.
which could indirectly be good news for the euro.
Okay.
But if the Fed signals they're not planning to cut rates anytime soon, that could strengthen the dollar and potentially weaken the euro.
It's like they're dance partners.
It is.
They're always influencing each other's movements.
This very intricate dance.
Before we wrap up this part of the conversation, I want to explore one more angle.
Okay.
The political landscape.
Okay.
We've talked about France.
Yes.
What about the bigger picture?
Yes.
How might that impact the future of the euro?
That's a great question, and one that a lot of investors are thinking about right now.
Yeah.
Political stability, or the lack thereof,
Right.
can have a huge impact on how currencies perform.
Uncertainty makes people nervous,
It does.
and that can really shake things up.
Absolutely.
So what are some of those political factors that we should be watching?
Well, elections are always a big one.
Yeah.
For instance, Germany is scheduled to hold elections in early 2025.
Okay.
And the outcome of that election could have major implications for the entire Eurozone.
How so?
Well, different parties have different economic and fiscal policies. So we could see changes in government spending or even shifts in the Eurozone's relationship with other countries.
Okay.
Any of these could boost or erode investor confidence in the euro.
So elections can be a bit of a wild card.
They can.
What other political factors should we be watching?
Another one is the rise of populism and nationalism
Okay.
in some European countries. These movements often favor policies that can be seen as economically risky,
Yeah.
and that leads to uncertainty
Right.
and volatility in the markets.
Okay. So are there any other political wild cards that we should be aware of?
Well, Brexit is still a factor.
It always comes back.
It does, even though the UK is no longer officially part of the EU,
Right.
the ongoing negotiations
Yeah.
and the trade deal between the UK and the EU could still have ripple effects on the Eurozone,
Okay.
especially if there are disruptions to trade or financial flows.
It's a lot to keep track of.
It is.
So we've got economic uncertainty, political risks,
Mhm.
and these upcoming decisions from central banks. With all that in mind, what's your overall assessment of the euro?
Well,
Is it a good investment?
as you might expect, there's no easy answer.
Like,
There are definitely scenarios where the euro could gain strength, especially if the ECB manages things well and those political risks start to diminish.
yeah.
But there are also things that could drag it down,
Okay.
like a global economic slowdown or renewed political instability.
So it's a mixed bag.
It is.
Opportunities and risks.
Exactly.
I guess that's what makes investing so interesting.
It does. It's all about weighing the pros and cons, making smart decisions,
Right.
and hoping to come out on top in the end.
But investing is a marathon, not a sprint.
Exactly. It's important to stay focused on the long-term fundamentals and make decisions that align with your overall financial goals.
Okay. So don't get too caught up in those day-to-day fluctuations.
Exactly.
Now let's talk about the US dollar.
Okay.
We discussed how sentiment might be turning away from the dollar.
Yeah.
Do you think that trend is going to continue?
That's a great question.
Or is the dollar still king?
Well, the dollar has enjoyed a long run as the world's reserve currency.
It has.
It's benefited from a number of factors: the size and strength of the U.S. economy,
Yeah.
the relative stability of the political system,
Right.
and the depth and liquidity of its financial markets.
So are there any challengers to the throne?
There have been some whispers of discontent in recent years,
Really?
especially from countries that feel like the dollar's dominance gives the U.S. an unfair advantage.
Mm-hmm.
Some have even proposed alternative reserve currencies
Wow.
or systems that would reduce reliance on the dollar.
So there's a potential power shift brewing.
It's possible.
What could drive that?
Well, one factor to consider is the rise of those emerging market economies,
Okay.
particularly China and India,
Right.
as those economies continue to grow
Yeah.
and become more integrated into the global financial system.
Yeah.
They're going to want more influence.
Right. The more economic power you have,
Yeah.
the more say you want in how things are run.
Yeah.
Okay. What else could shake things up?
Another thing to watch is the increasing adoption of cryptocurrencies
Okay.
and other digital assets. Now, while it's still early days for crypto,
Yeah.
it has the potential to disrupt traditional financial systems
Right.
and create new ways for making international payments and investments.
So crypto is kind of a wild card.
It is.
It could be huge, or it could just fizzle out.
We'll have to wait and see.
It's hard to say.
It is. The world of finance is constantly changing.
It is?
It's important to stay flexible.
Right.
But no matter what happens with crypto or the dollar's dominance, one thing remains constant:
What's that?
diversification.
Diversification. That's the golden rule.
It is. By spreading your investments across different asset classes, currencies, geographic regions,
Right.
you can manage your risk more effectively and potentially improve your returns.
So even if the dollar loses its top spot, it's still smart to have some exposure.
Yes. But we should also be exploring other currencies and opportunities.
Right. To hedge our bets.
Exactly. We live in an increasingly interconnected world,
We do.
and having a global perspective is essential for investing.
This has been an incredibly insightful conversation.
So, Cree,
We've learned so much
we have.
from the euro's prospects to the bigger trends shaping the global economy.
It's a lot to take in.
So what are some of the key takeaways
Mm.
that our listeners should remember?
Well, I think the most important takeaway is that uncertainty is the new normal.
Okay.
Things can change very quickly, so stay adaptable.
Be ready for anything.
Exactly.
Any other pearls of wisdom?
Yes. I can't emphasize enough the importance of critical thinking.
Yeah.
Don't just follow the headlines or get caught up in the herd mentality.
Right.
Do your own research, seek out different perspectives,
Yeah.
and ultimately make decisions that align with your financial goals.
And your own risk tolerance.
Yeah,
Critical thinking. It's the superpower we all need.
it is.
So before we wrap up, I want to thank you so much for sharing your insights with us today.
It's been my pleasure.
It's always a pleasure to have you on.
Likewise.
And thank you to all of our listeners for joining us on this journey.
Yes.
Thank you. We'll be back next week with another deep dive into the world of money markets and the forces that shape our financial futures.
Looking forward to it.
That was a lot of information.
It was. We covered a lot of ground.
We did. I feel like we traveled the world.
We kind of did.
Okay, so let's get back to that title from the article. We were talking about tired of buying dollars, but not confident enough to buy euros.
Right.
We've talked about all these different factors that are influencing these currencies. But do you think now is the time to reconsider that dollar-heavy strategy?
Well, that's the million-dollar question, isn't it?
It is.
And there's no easy answer. Unfortunately,
Okay.
it really depends on your personal circumstances, your risk tolerance,
Right.
your long-term goals, a lot of different factors.
So it's not a simple yes or no.
It's not.
What are some of the questions that someone should ask themselves when they're trying to make this decision?
I would start by encouraging everyone to take a look at their overall investment strategy.
Okay.
Does it still align with your goals? Has anything changed in your life that might warrant some adjustments?
Right. It's easy to set it and forget it.
It is.
What else?
I'd also suggest taking stock of your current currency exposure.
Okay.
How much of your portfolio is actually in US dollars? And are you comfortable with that level of exposure?
Right. It goes back to diversification.
Exactly. Don't put all your eggs in one basket.
Even if it seems like the safest basket.
Right.
So if someone is considering diversifying into other currencies,
Yeah.
is the euro a good option?
The euro might be worth a look.
Okay.
As we've discussed, it's definitely facing some challenges.
Right.
But it also has the potential to appreciate in value,
Okay.
especially if the ECB handles things well
Right.
and some of those political risks start to fade.
So it's a bit of a calculated risk.
It is,
Yeah.
but with potential for reward.
Okay. Any final words of advice for our listeners who are trying to figure this all out?
Don't rush into any decisions.
Okay.
Take your time, do your research,
Yeah.
and don't hesitate to talk to a financial advisor
Good advice.
if you need help, making those decisions.
Right. Because sometimes that fear of missing out, FOMO,
Yes.
can really drive some bad decisions.
It can. You want to make sure that you're making choices that are right for you.
For your circumstances.
For you, exactly. And remember, the financial world, it's always changing.
It is.
So what might seem like a good idea today could be a totally different story tomorrow.
Right. So stay informed,
Yes,
stay adaptable.
absolutely.
Never stop learning.
Couldn't have said it better myself.
This has been a great conversation.
It has.
I feel like we've learned so much
Me too.
about the euro,
Yeah.
the dollar.
Yeah, the whole global economy.
It's fascinating.
It is.
So to our listeners out there, thank you so much for joining us today.
Yes. Thank you for listening.
We hope you enjoyed this deep dive.
We
And we'll be back next week with another one.
looking forward to it.
So until
Euro
then,
stocks
stay curious,
50.
stay informed, and keep on diving. Yeah.
It's been on like a crazy winning streak,
Yeah.
8 straight days of wins. We're going to break down like how unusual this rally is, what's fueling it, and what it could all mean for, your investments, especially with the euro dollar exchange rate.
So what's interesting about this rally is not just the duration.
Right.
It's the strength.
Right.
You don't see the Euro Stocks 50 or SX5E outperforming the S&P 500 for 8 straight days every day.
Yeah.
In fact, analysts at Barclays say we've only seen this happen once in the last 25 years.
Wow. Once in 25 years. That's pretty rare.
It is. It's like an eclipse.
Yeah.
You don't see that every day. And what makes it even more impressive is the high information ratio,
Okay.
which means you're getting, good risk-adjusted returns.
Yeah, right.
You're getting a lot of bang for your buck.
Yeah.
But of course, the question is,
Yeah. What's driving that?
what is causing this surge? What's driving it?
Yeah.
So Barclays has identified 3 main factors at play.
Okay.
The first one is what they call significantly bearish positioning.
Oh.
So imagine everyone thinks that, you know, a soccer team,
Right.
they're going to lose their next match.
Okay, yeah.
So they're all betting against them.
Yeah.
Then suddenly the team wins.
Wow.
Now, everyone who bet against them has to scramble to cover their losses.
I see. So like everyone was, I guess, pessimistic
Yeah, pessimism.
about the European market, so they were betting against it.
Exactly. And that pessimism, that's what we call bearish positioning.
Okay.
And when the market didn't crash like everyone expected, it actually created this perfect environment for an upswing.
So everyone's like rushing back in.
Exactly. Everyone's trying to make up for those losses.
I see. So is that where this technical driven squeeze comes in?
Yes, exactly. So all that rushing to buy back in,
Right.
it can really create a snowball effect,
Okay.
especially with short selling involved.
Right.
It's like, imagine, you know, you bet against that soccer team
Yeah.
and they keep winning and winning. You probably want to cut your losses at some point.
Right. You don't want to keep losing more.
Exactly. So
No.
you buy back in, hoping to avoid even more losses.
Right. Okay, that makes sense. So negative sentiment created this opportunity.
Yeah.
And then everyone rushing back in just kind of fueled the fire.
Yeah, it fuel to the fire. Exactly.
But the third factor, this is what I'm a little confused about.
Okay.
The potential for ECB rate cuts.
Right.
Doesn't that weaken a currency?
Yeah. So that's the interesting thing.
Okay.
Usually, when a central bank like the ECB hints at rate cuts,
Mhm.
yeah, it can make their currency less attractive.
Right.
But here's the twist.
Okay.
The expectation of these cuts is actually being interpreted as a positive for European stocks.
So even though the euro might weaken, it
Right.
could actually boost European companies.
Exactly. It's like a balancing act, really.
Okay.
So while lower rates might impact the euro,
Right.
they can also stimulate the economy
I see.
because it becomes cheaper for businesses to, you know, borrow money and invest.
Right. Okay.
And this can lead to higher company earnings,
Oh, okay.
and that could push stock prices up.
Oh, I see.
Plus, don't forget, the market was kind of bracing for a downturn.
Right.
So any sign that the ECB is willing to step in and help
Yeah.
is seen as a good thing.
Like a safety net.
Yeah, exactly. A little bit of support.
Okay. It's like the market was holding its breath
Yeah.
and now it can finally exhale a little bit.
Exactly.
But then there's this other thing, right? Where like even small bits of good news, it seems like, have been like making big waves.
Absolutely.
Yeah.
It's almost as if investors were like starved for any kind of positivity.
Yeah.
You know, remember that initial bearish sentiment?
Yeah.
When expectations are so low, any little positive development,
Yeah.
it can seem like a huge win.
Right. So we've got this mix of factors, bearish positioning, technical squeeze, potential rate cuts,
Mhm.
and this market that is just like super sensitive to any good news.
Very sensitive, yeah.
It's no wonder the Euro Stoxx 50 is like taking off.
It's soaring,
But can it last?
right? That is the million-dollar question.
Is this the start of something big, or are we headed for like a sudden drop?
That's the big question. So when Barclays looked at the historical data
Okay.
for, similar squeezes in the SX5E,
Mm-hmm.
the picture is a little mixed.
Okay.
Some were followed by long rallies,
Right.
and others kind of fizzled out
Yep.
and led to corrections.
So there's no easy answer.
It's really hard to say for sure.
Like trying to predict the weather?
Exactly. You could look at all the signs, but there's always that element of unpredictability.
Right. But even with all this uncertainty, you mentioned that Barclays still sees like some good reasons to consider European equities.
Yes, that's right.
Even now.
Despite all the uncertainty,
Yeah.
this market environment may present some unique opportunities,
Okay.
especially if you know where to look.
Okay, so where should we be looking?
Well, one area that stands out is option pricing.
Okay, options. Now this is where I get a little lost.
Yeah, I understand. Options can seem a bit complex,
Yeah.
but they can also be powerful tools.
Okay.
Think of them like insurance for your investments.
Oh, okay.
You pay a premium for the right to buy or sell an asset at a specific price
Right.
in the future.
Okay.
And the recent rally has actually made these premiums, also known as implied volatility, much cheaper for European indices.
Right.
In fact, we're seeing levels close to their lowest point in 5 years.
So it's like getting insurance at a discount.
Exactly, like
Yeah.
a sale on insurance.
Okay, that makes sense.
And it's not just the overall cost of options.
Right.
The call skew has also declined.
Now, I'm going to need you to break that down for me. What
Yeah.
is call skew, and why should I care if it's going down?
Okay, so call skew essentially tells you how much more expensive it is to buy call options.
Okay.
Which are bets that the price will increase.
Right.
Compared to put options, which are bets that the price will go down.
Gotcha.
So a lower call skew basically means it's getting cheaper to bet on the market going up.
Okay, so if someone is like optimistic about the Euro Stocks 50,
Yeah.
now might be a good time to like look at options.
Yeah. It'd be a good time to explore that. It doesn't mean the rally is guaranteed to continue, of course.
Right.
But options can provide a way to, participate in any potential upside while limiting your risk.
So it's like having like a safety net
Exactly. A little bit of a cushion.
while you're, doing something risky.
Exactly.
Okay, that's reassuring. So now what about this steepening volatility term structure that Barclays mentioned?
Oh, yes. The volatility term structure.
What is that?
It sounds complicated, but it's not really.
Okay.
It basically refers to how volatility expectations
Okay.
change over different time frames.
Okay.
And in the case of the Euro Stoxx 50, we're seeing a much wider gap
Okay.
between short-term and medium-term volatility.
Can you give me an example? Like, what does that look like?
Sure. So let's say the volatility for 1-month options is relatively low right now.
Okay.
Maybe because everyone's focused on this short-term rally.
Right.
But the volatility for, say, 6-month options is much higher.
So that means that like things seem calm now.
Yeah.
But there's still like a sense of unease
Yeah, exactly.
about what might happen later on.
That's a great way to put it.
Like enjoying a sunny day at the beach,
Yes.
but knowing that there might be thunderstorms later.
Exactly. A perfect analogy.
So does that mean this is a good time to like buy?
Well, it actually presents an interesting opportunity
Okay.
for investors with a longer-term outlook.
Oh,
Yeah.
okay.
Yeah.
So if there's like this uncertainty, why would longer term investors be interested?
Well, think of it this way. If the market is pricing in more risk for the medium to long term,
Mm-hmm.
it could mean that assets are undervalued compared to where they might be
Right.
in, 6 months or a year.
So for someone willing to like ride out the bumps,
Yeah.
this could be a chance to buy low,
Exactly.
hoping to sell high later on.
It's a classic buy the dip scenario.
Right.
But of course, it's not without its risks.
Right.
That's why it's important to, do your research
Of course.
and understand the downsides.
And speaking of risks, we can't forget about the euro dollar exchange rate
Yes, that's important.
and how this rally might impact it.
Right.
We talked earlier about how those potential ECB rate cuts,
Yeah.
which, could be good for European stocks,
Yeah.
might actually weaken the euro.
Right.
But then you also mentioned that like the positive momentum in the stock market might actually counteract that.
Precisely. It's kind of like a tug of war.
Okay.
On one hand, lower interest rates usually make a currency less attractive.
Right.
But on the other hand, if European companies are doing well
Mm,
and investors are optimistic about the future,
yeah.
that could increase demand for the euro
Right.
and potentially offset the impact of those lower rates.
So it's like a seesaw with all these different forces pushing and pulling.
Exactly.
So if someone is like trying to figure out where things are headed, like what should they be watching?
That's a great question.
Yeah.
First and foremost, I'd keep a close eye on economic data coming out of the Eurozone.
Okay.
Things like GDP growth, inflation numbers, unemployment rates, all those things will give you a sense of the health of the European economy.
Okay.
Is this rally a sign of a true recovery
Right.
or just a blip?
Right. Right. And of course, anything from the ECB,
Of course, yeah.
especially about interest rates.
Absolutely. The ECB's actions and statements
Right.
will be key in understanding how they view the current situation
Yeah.
and if they plan to provide more support.
It seems like you need to pay attention to a whole bunch of things.
Yeah, there are a lot of factors at play.
That's what makes it so interesting, right?
Exactly. It's a dynamic world constantly evolving.
Yeah.
And that makes it challenging,
Right.
but also rewarding.
So no crystal ball,
Huh.
but by staying informed, investors can hopefully like make good decisions.
Precisely. Stay informed, do your research, and be ready to adapt.
Okay. Adapt as things change.
Exactly.
And who knows, maybe this rally is just the beginning of something bigger.
It's possible. We'll have to wait and see.
That's the exciting part.
Yeah.
Thanks for joining us on this deep dive into European markets. We hope you found it insightful.
Thanks for having me.
And as always, keep exploring
Yeah.
and learning.
Keep learning.
So, if there's like this uncertainty, why would longer term investors be interested? It seems counterintuitive.
Well, think of it this way. If the market is pricing in more risk for the medium to long term, it could mean that assets are undervalued
Okay.
compared to where they might be in, 6 months or a year.
So for someone willing to like ride out the bumps,
Yeah.
this could be a chance to buy low, hoping to sell high later on.
It's a classic buy the dip scenario.
Right.
But of course, it's not without its risks.
Right.
That's why it's important to, do your research
Of course.
and understand the downsides.
And speaking of risks, we can't forget about the euro-dollar exchange rate
Yes, that's important.
and how this rally might impact it. We
Right.
talked earlier about how those potential ECB rate cuts, which, could be good for European stocks,
Yeah,
might actually weaken the euro.
right.
But then you also mentioned that like the positive momentum in the stock market might actually counteract that.
Precisely. It's kind of like a tug of war.
Right.
On one hand, lower interest rates usually make a currency less attractive.
Right.
But on the other hand, if European companies are doing well
Mm-hmm.
and investors are optimistic about the future,
Yeah.
that could increase demand for the euro
Right.
and potentially offset the impact of those lower rates.
So it's like a seesaw with all these different forces pushing and pulling.
Exactly.
So if someone is like trying to figure out where things are headed, like what should they be watching?
That's a great question. First and foremost, I'd keep a close eye on economic data coming out of the Eurozone.
Okay.
Things like GDP growth, inflation numbers, unemployment rates, all those things will give you a sense of the health of the European economy.
Okay.
Is this rally a sign of a true recovery?
Right.
Or just a blip?
Right. Right. And of course, anything from the ECB,
Of course, yeah.
especially about interest rates.
Absolutely. The ECB's actions and statements
Right.
will be key to understanding how they view the current situation
Yeah.
and if they plan to provide more support.
It seems like you need to pay attention to a whole bunch of things.
Yeah, there are a lot of factors at play.
It's what makes it so interesting, right?
Exactly. It's a dynamic world constantly evolving,
Yeah.
and that makes it challenging,
Right.
but also rewarding.
So no crystal ball, but by staying informed, investors can hopefully like make good decisions.
Precisely. Stay informed, do your research, and be ready to adapt.
Okay. Adapt as things change.
Exactly.
And who knows, maybe this rally is just the beginning of something bigger.
It's possible. We'll have to wait and see.
That's the exciting part.
Yeah.
Thanks for joining us on this deep dive into European markets. We hope you found it insightful.
Thanks for having me.
And as always, keep exploring
Yeah.
and learning.
Keep learning.
So if there's like all this uncertainty,
Yeah.
why would longer term investors be interested?
Right.
It seems a little counterintuitive.
Yeah, it does seem that way. But think about it this way.
Okay.
If the market is pricing in more risk for the medium to long term,
Okay.
that could actually mean that assets are undervalued
You're right.
compared to where they might be, 6 months or a year from now.
So you're saying for someone willing to kind of like ride out those bumps,
Exactly.
this could be a chance to buy low and hopefully sell high later on.
Exactly. It's the classic buy the dip scenario.
Oh yeah, classic.
But of course, it's not without risk.
Right. Of course not.
That's why it's always crucial to, do your research
Yeah.
and understand the potential downsides.
Right. And speaking of risks, can't forget about that euro-dollar exchange rate
Yeah, that's a big one.
and how this rally might impact it.
Right.
We talked earlier about how those potential ECB rate cuts
Yeah.
could be good for European stocks, but might weaken the euro. But then you mentioned that the positive momentum from the stock market might actually counteract that.
Exactly. It's a bit of a tug of war.
Oh, okay.
On the one hand, lower interest rates can make a currency less attractive
Right.
to foreign investors.
Right.
But on the other hand, if European companies are performing well
Okay.
and investors are feeling good about the future,
Yeah.
that could increase demand for the euro
Okay.
and offset the impact of those lower rates.
So it's like a seesaw with these different forces kind of like pushing and pulling.
Exactly. A constant push and pull.
So much to think about.
It is.
What should people be watching closely?
Well, if I were an investor,
Yeah.
first and foremost, I'd keep an eye on economic data coming out of the Eurozone.
Okay.
Things like GDP growth, inflation numbers,
Yeah.
unemployment rates, all that.
Okay.
All those things will give you a sense of the health of the European economy.
Okay. So is it actually recovering?
Yeah, is it really bouncing back?
Or is this rally just like a temporary thing?
Yeah, exactly. Is it sustainable?
And of course, we can't forget about announcements from the ECB,
Absolutely.
especially about interest rates.
Yeah. Anything about interest rates is going to be big news
Big news.
because the ECB's actions and their statements
Right.
are really key
Yeah.
to understanding how they see things
Oh, okay.
and what they might do to support the economy.
It really seems like you need to be paying attention to so many things.
You do. It's a lot to keep track of.
But that's kind of what makes it so interesting, right?
Exactly. That's the beauty of it. The financial world is always changing.
Yeah.
It's dynamic, and that makes it challenging, but also incredibly rewarding.
So there's no crystal ball?
Unfortunately not.
But being informed is key.
This is absolutely key. Stay informed, do your research,
Yeah.
and be prepared to adapt as things change.
Be adaptable.
Exactly.
Well, that's great advice.
Thank you.
Thanks for joining us for this deep dive into the European markets and the euro.
It was my pleasure.
Hope you learned something.
Me too.
We encourage you to keep exploring and learning.
Always keep learning.
Until next time, happy investing, everyone.
Happy investing.
Policy, and that could very well affect interest rates into the future.
Well, and that's especially prescient that you raise that, considering we just last night got the text of a continuing funding resolution that will kick the can down the road to March 14th, at which point we will be halfway through the fiscal year that all of this budget was supposed to be addressing, which just speaks to how broken our fiscal system here in the U.S. actually is. Are you concerned by the kind of longer-term ramifications of that, considering Chairman Powell, while he does not like to weigh in on fiscal policy, does repeatedly say, the cost of the debt and deficits is something we have to keep in mind, and does, of course, feel the impact of whatever rate decisions that they are making. Just how do you view the machinations here in Washington through that lens?
It's very reminiscent of the chorus we've heard from people leaving Congress, House and Senate, Republican and Democrat, that they believe the system inside Congress is broken. It is a place that is moving more and more dysfunctional with every passing year. And as much noise as we make about how we need to fix government, most of the decision making on to improve government, to improve spending, to improve our fiscal position, all of it comes back down to Congress. And yet we have had less kind of policy making, less attention about how to make Congress work better in its own internal processes that so many people have said as they leave. This place is broken. And I really do worry about, being 6 months into a year and not having funding, and it's an election year, and we want to do this. But it does evince just a lack of ability to get things done.
Yeah. Well, we know they do have a long list of things that they want to get done next year, Catherine, including, if you believe the incoming Senate Majority Leader, addressing border and immigration issues first in a budget reconciliation package, of course, in keeping with the language we heard from Donald Trump on the campaign trail about what he wants to do. He wants to start mass deportations basically immediately after taking office. And considering that the Fed also has to keep in mind the dynamics in the labor market as one half of their dual mandate, how do you think the immigration question, let alone what's happening with taxes and tariffs, is going to weigh on monetary policy moving forward, if indeed this all comes to fruition?
Well, you have to know that when someone says, I would like to deport mass numbers of people, you have to interpret that as, I would like to reduce the size of the economy. Our economy is a function of the number of people working in it. It is a very clear mapping onto that. So when you say, I want to deport people, that would be the same as saying, well, I would like to lay off 5 million people. And it's very hard to get to a scenario where we have greatly shrunk the size of the economy and not have it affect monetary policy, not have it affect fiscal policy. It's not as if it's very easy for the government to save money as the economy is actively shrinking. I think that this policy gets people mad. I think it gets people nativist. It's nice to feel good about yourself as you kind of point at other people and say they're the actual reason for all of our problems. But at the end of the day, you might consider them not Americans, but they are workers. And their identity as a worker matters more to the economy than whatever place they were born.
Finally, Catherine, we just have a minute left here, and I know you said it'll be a minefield for Chairman Powell today. It's very hard to predict what 2025 is going to look like for him and the FOMC. But if you had to call it now, how many rate cuts do you think they'll deliver next year?
If I had to call it now, No, I can't do it. It's just there's too much uncertainty. I think he's going to telegraph we're going to stay on target and hopefully have 6 rate cuts. But you're entering this whole other problem that we haven't even talked about whether or not we're close to the neutral interest rate or if it has changed and how low they actually need to go, not just how fast they need to get there and how many steps it'll take. So I don't know if I could say it, maybe just 6. Just split it. I'll say 6, but know that it's an entirely uninformed guess around what I think the Fed will do. If that's helpful to your viewers.
It always is. Catherine Edwards, economic policy consultant. Great to have you on Balance of Power as always. And if we don't talk to you again, Happy New Year to you, and we'll see you in 2025 when, as she alluded to, the economic picture is pretty uncertain. We didn't even have time to touch our star, so we'll have to save that for later on. Of course, the Fed Special, a special edition of Bloomberg Surveillance, will be later on today on Bloomberg, but we have more Balance of Power straight ahead.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. I'm Charlie Pellet. We have got the Dow, the S&P, NASDAQ all advancing. S&P right now up 10 at 6,061. That is a gain of about 0.2%. Stocks have been swinging between modest gains and losses as investors await the Fed decision at 2 o'clock Wall Street time. We've got the Dow up 204 now, up 0.5%, while NASDAQ is up by 0.1%. The 10-year, 4.39%. The 2-year, 4.22%. Gold now down $8 the ounce to $26.38, a drop of 0.3%. West Texas Intermediate crude holding above $70, $70.71 right now on WTI, up by about 0.9%. And a retreat now for Bitcoin, down 1.5%, $104,800 on Bitcoin. Just over an hour away from the latest Fed decision. Then at 2:30, we get Fed Chair Jay Powell's news conference. Catherine Edwards is a labor economist and policy consultant, also a Bloomberg contributor, and she was interviewed moments ago right here on Bloomberg Balance of Power.
I mean, I think what I'm looking for today is less so the rate announcement itself and more the telegraphing of the next year, what they've taken into account and what he says in both his press conference and what we get from the new dot plot.
And again, that press conference, the news conference, 2:30 p.m. Wall Street time here on Bloomberg Radio. Honda is in talks to come to the aid of Nissan Motor by potentially forming the world's third largest car maker in order to better withstand escalating challenges for the global auto industry. Honda Motor down 2.5% today. Nissan ADRs, they're surging by 19.7%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. Balance of Power continues. Back we go to Washington once again. Your host, here she is, Kaylee Lines.
All right, Charlie Pellet, thank you very much. I'm Kaylee Lines in Washington, where we finally got it last night. The text of a long-awaited stopgap measure, a continuing resolution to keep the government funded past midnight on Friday. It will keep the funding going until a deadline of March 14th. But it's not just that this legislation does. It is jam-packed with a slew of measures, making it look like if not an omnibus, what some are referring to as a cramnibus package that's being forced through at the very end of the year and, of course, the end of the 118th Congress, which is exactly what the Speaker of the House, Mike Johnson, said he didn't want to do, but is now asking his conference to vote for. That's left many of them in the House quite upset over this, and it goes well beyond Capitol Hill as well, as Elon Musk, who of course is getting set to co-lead this new Department of Government Efficiency in the incoming Trump administration, said simply, this bill should not pass. And the Speaker of the House, Mike Johnson, had to address the concerns of Musk and his co-lead of the Doge, Vivek Ramaswamy, in an interview on Fox earlier this morning.
Vivek and I talked last night about almost midnight, and he said, look, I get it. He said, we understand you're in an impossible position. Everybody knows that. Remember, guys, we still have just a razor-thin margin of Republicans, so any bill has to have Democrat votes. They understand the situation. They said, it's not directed to you, Mr. Speaker, but we don't like the spending. I said, guess what, fellas? I don't either. We got to get this done because here's the key. By doing this, we are clearing the decks, and we are setting up for Trump to come in roaring back with the America First agenda.
So let's get into this now with our signature political panel. Rick Davis, Republican strategist and Stone Court Capital partner, is here alongside Democratic strategist Jeannie San Zeno, senior democracy fellow at the Center for the Study of the Presidency and Congress, also of Iona University. Rick, if we could just begin with you, considering that assuming this does get done, which I guess is still no guarantee at this point, it's just a few weeks until Speaker Johnson is going to have to face a vote to be Speaker again. Did he just do something to diminish his odds of getting the gavel once more?
Well, he certainly made a lot of people upset with promises made, promises not kept. And remember, this was the big complaint of his predecessor, that he would make commitments that he didn't keep. And so last thing you want to do is start looking like the guy you just threw out this year earlier. And so, yeah, I think that it could create a little bit of a rumbling. Look, at the end of the day, I think the Republican caucus will do what Donald Trump wants to do. And if Donald Trump has confidence in Johnson, then he shouldn't have a problem. But there's no guarantee that Donald Trump doesn't listen to the Freedom Caucus and Elon Musk and say, hey, you know, you should have held this thing up and what you've done is wrong and I'm going to withdraw my support. So it could be a pretty rocky holiday season for Speaker Johnson.
Well, and of course, how rocky it is might ultimately come down to the folks on the other side of the aisle, Jeannie. For every big piece of spending legislation this Congress, it has required Democratic votes to get it over the finish line. If this package, this funding package, is pursued on the floor or brought to the floor under a suspension of the rules, which is kind of the expectation now, it's going to require Democratic votes. It might require Democrats to protect Speaker Johnson if things really start to go haywire come January. Is there going to be appetite for that?
Yeah, I mean, I think there'll be appetite for it, but it will also be a payback. They will expect something in return, and that's what's gotten Johnson into this predicament, if you can call it that, that he has had to deal with the Democrats as well, knowing he needs them to get over the line. And, you know, it's listening to his comments this morning on Fox, you scratch your head. He's saying things like, when we take back control or when we take control, he is in control. He is in the majority. We're going to clear the decks and come roaring back. Yeah, you're in control now. You'll be in control again with a narrower margin. So if he survives this cramnibus, I like it, Kayleigh. If he survives it, if he survives the speaker vote, we do this all over again in 3 months, and it is not going to get any easier. I mean, some of the commentary you're hearing from the hardliners, it's a complete monstrosity. It's $330 billion added to the deficit, nothing paid for. I mean, this is how they see this. And so his job has gotten worse. And, you know, we haven't heard from Donald Trump yet. I assume he'll support him through this, but maybe he goes with his BFF, Elon Musk, and that's going to be big trouble for Mike Johnson if he did that. I don't suspect he will, but if he did.
I feel like I need to make it clear, I did not originate Cramnibus, though it is creative. That instead comes from the House Freedom Caucus, which I think will surprise no one that they are unhappy with this measure, as they don't typically like continuing resolutions in any form, even when they're jammed with other things. To the point Jeannie was just making, Rick, this notion that if Johnson thinks he's struggling with control now, it's probably only going to get harder mathematically until special elections can be held in the spring to fill the seats of those who will be leaving to join the Trump administration. There's going to be potentially one vote to lose, and Victoria Spartz, the congresswoman from Indiana, has suggested she's not going to be conferencing with Republicans, even though she will remain one. So it does raise the question, not just on funding come mid-March, but on reconciliation, on the variety of priorities that this incoming administration and Congress has. What realistically is going to be able to be accomplished in the first 100 days?
Yeah, you point out a real vulnerability to this incoming Congress, the narrow margin of victory that Republicans have made even more difficult by people like Congresswoman Sparks, who say, you know, I'm not going to be a pushover. I'm not going to attend committee meetings. I'm not going to be part of the caucus. I think for the purposes of majority status, she'll be fine. But that's nothing. Once you're in the majority, you're going to have to deal with razor-thin two-people margin. And it does empower lots of different groups, not just the usual troublemakers like the Freedom Caucus, but really just anybody with a grudge puts any kind of legislation in play. And this go round, I mean, you're not getting a full 72 hours, which was committed to when Speaker Johnson took the gavel. You're doing things outside of regular order, which has never been adhered to in the last year. I mean, all the commitments that this group made prior to the election have really been thrown out the door in this one act. And so nobody has any expectations that next year is going to be any better. And so, yeah, I think we can see more and more Kremlin buses going on, driving down that street.
Well, and when we consider that this election, the 2024 election, is past us, the next one isn't that far away. When we consider the midterms in 2026, it's really only next year that this Congress will be operating outside of the election year, when everybody agrees it's way harder to get things done. And I do wonder electorally if some of the measures within this are putting especially vulnerable members in a tough spot. Jeannie, specifically the fact that this does offer a cost of living adjustment for members that has been blocked since 2009. Granted, they haven't had cost of living adjustments since then, but effectively giving yourself a pay raise, Jeannie, is that going to go over well with the American electorate?
You know, it never does. I am one of those people who thinks that they do need a pay raise. And I thought the quote in Bloomberg today by Austin Scott of Georgia was exactly the reason why we do need them to have a cost of living adjustment. Because if you don't pay your representatives and senators, that means that people from the lower and middle classes cannot afford to serve in Washington, D.C. You need two homes. You've got some members ridiculously sleeping in their offices because they can't afford it. So, yes, they need it. But politically, it's always, always dangerous to put it up there. So that's why I think they're trying to sneak it in at the end of the year and hope that in 2 years' time, when election season comes about, people forget about it. So it is needed, but it is not going to be a political winner. I think you're not going to hear a lot of people campaigning on it is probably the best way to say it.
Yeah, Rick, do you see this one coming back to bite?
Sure, it's a TV commercial ready to be made. And it's really not a fair criticism, but as Jeannie says, American people, you know, they blanch at these kinds of things, especially in these last minute, must spend kind of vehicles where it's not debated, it's not processed through a committee, it hasn't gone through regular order. Nobody has debated the efficacy of this, even though it makes sense from just a basic concept. But yeah, I mean, look, it's always tough in a midterm election for the party in power. Republicans are going to hold all three chambers, 2 chambers of Congress and the presidency. It's going to be an ugly 2026 for these guys, and they are going to have to rush to get as much done as they can with the hope that they can actually keep their caucus together, which based on today is no guarantee.
Well, and when we look ahead to 2026, it's, of course, July 4th, 2026, when the Doge under Elon Musk and Vivek Ramaswamy is supposed to have done all of their recommendations and tell us how they're going to cut what they say will be trillions of dollars potentially in spending. So to come back to the Elon Musk of it all, Rick, if Elon Musk says this bill shouldn't pass, and then it ultimately does, why should we believe that Congress will then act on the recommendations of Elon Musk and Vivek Ramaswamy when they say, okay, this is what you should do with government spending?
Yeah, I mean, just because they call it a department shouldn't be confused. It's a commission. They aren't an agency of government and they have no power. So it will run the course of a normal commission. And most of these commissions get very little actually enacted by Congress. Usually they're chasing yesterday's news. 18 months from now is going to be different than today. Look, I don't blame Elon Musk. He could save $300 billion by torpedoing this and throwing our country into disarray with a lockdown of government right before Christmas. But so his approach would be just cut anything that's moving. So at the end of the day, I think I look forward to seeing the recommendations of the Doge because government does need reform. I mean, we are antiquated. We have not taken advantage of the great skills of our tech sector in places like the Department of Defense. Elon Musk could do enormous good by helping streamline the function of government and save the country an enormous amount of money. But we're a long way from seeing that actually enacted.
Well, and I do wonder if one of the recommendations might ultimately be, Jeannie, quit it with these continuing resolutions and stopgap measures and threats of a government shutdown that actually cost more money.
It absolutely should be. I mean, we have heard so often a return to regular order. I'm praying for it, hoping for it. Nothing is happening. This certainly is not it. But, the thing that is so, about the Elon Musk of it all, as you said, Kaylee, is, he's about an hour late from Donald Trump. He was tweeting about this at 4:15 a.m. this morning. And Donald Trump was up at 3:15 a.m. tweeting about other things, including Liz Cheney. So I think, Elon Musk may need to take a page out of Donald Trump's book and get up an hour early so they can tweet together or social truth together, whatever they're doing. But we would hope to return to regular order, but it's going to take more than Elon Musk saying we should. It's going to take structural reform. And none of these guys are talking about that, or ladies are talking about that. And that's really where we have to see the meat. And we haven't heard anything in that regard.
Well, right on cue, a fresh tweet hits from Elon Musk, or X post, I guess I should say. It's actually a repost, reposting someone saying it's crazy what they are doing, referring to the continuing resolution. They should just be passing a bare minimum funding bill to get through the end of January when Trump takes power. To that, Elon Musk says, exactly. But we'll see if that's heeded at all. Jeannie Shanzano and Rick Davis, our signature political panel. They'll be back with me for more in the next hour of Balance of Power. We have much more to discuss in politics, but also, of course, the fact that it's Fed Day, with the rate decision now just over 1 hour away. So we'll get into that as well. Just stay with us here on Balance of Power on Bloomberg Radio.
politics to the world of business. This is Balance of Power. Live from Washington, D.C.
They say you know you have a deal when nobody is happy. Maybe that's the case with government funding. Welcome to Balance of Power on Bloomberg TV and radio. I'm Kaylee Lyons, live in Washington, where we have finally received the text of a continuing resolution to keep the lights on for the federal government. past Friday, but it's jam-packed with other measures that have a lot of members of Congress upset. And we'll get into the details with Jack Fitzpatrick of Bloomberg Government and our signature political panel, Rick Davis and Jeannie Shanzano. Plus, we are just 1 hour out from the Fed's final rate decision of the year. And we'll have more on that with Joe Livornia, who used to be the chief economist for the National Economic Council in the first Trump White House. So all of that is ahead, but before we get the Fed decision, let's check on the Fed day markets ahead of it. Charlie Pellet has a look from New York. Hey, Charlie.
Hi, thank you very much, Kaylee Lyons. Good day from New York. All eyes certainly on the Federal Reserve. Now just under 1 hour to go. We've got the Dow, the S&P, NASDAQ all in the green right now. S&P advancing 11 points, up by about 0.2%. The Dow up 164, up by about 0.4%. NASDAQ holding on to a gain of 36 points, up by about 0.2%. 10-year at 4.38% this Fed Wednesday. The 2-year currently at 4.22%. Gold down 0.4%, 26.36 the ounce. And West Texas Intermediate crude up 0.9%, 70.74 a barrel for WTI. Bitcoin lower now by 1.7%, 104,590 right now on Bitcoin. New home construction unexpectedly fell in November as a drop in multi-family projects mitigated a rebound in starts of single-family houses solely in the storm-ravaged South. Among home builders today, Lennar, which reports after the close of trading up 0.4%. Toll Brothers lower now by 0.6%. KB Home just about unchanged on the day. Again, a reminder, we've got special coverage for you coming up on Bloomberg Television and Radio, 1:30 p.m. Wall Street time here on Bloomberg. Briefly, the U.S. Supreme Court says it will hear TikTok's challenge to a law that would ban the social media app if it is not sold by its Chinese parent company, scheduling arguments for January 10th. And New York's Metropolitan Transportation Authority has approved a nearly $20 billion operating budget for 2025. It does include a planned 4% fare and toll increase. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. Balance of Power continues. Back we go to Washington. Once again, here she is, Kaylee Lyons.
All right, Charlie Pellet, thank you so much. With a look at where we stand with less than 1 hour to go until the Fed rate decision, where, of course, we're expecting a 25 basis point rate cut and a view into 2025. Usually, those Fed statements that we get right at 2 p.m. Eastern time are relatively short, just a couple of pages long. And I want to begin by talking about something that is a whole lot longer than that. A 1,547-page piece of legislation. It's the continuing resolution, the stopgap measure that will keep the government open past the deadline of midnight Friday. There's a lot of stuff in this thing, from laws around pharmacy benefit managers, what happens with RFK Stadium, disaster relief, which perhaps is the most palatable item in this for a lot of lawmakers. And it even gives lawmakers a pay raise through a cost of living adjustment that was first noted and noticed by Bloomberg Government's Jack Fitzpatrick, who, of course, covers Congress for BGov, and he's joining me now here on Balance of Power on Bloomberg TV and radio. So, Jack, this is a monster piece of legislation. How did it get so big?
It gets so big because you need to get people to vote for it, and you already know a lot of the hardline conservatives and maybe swing district members aren't going to vote for it. So when they complain about the fact that this is not the right way to legislate, it's not a good idea to just drop 1,500 pages in their lap right before a deadline. When they complain that they didn't ask for a pay raise, you say, well, you know, if you weren't going to vote for a major piece of legislation anyway because you don't see it as good governance, then you've played yourself out. This is going to the members who represent rural America and wanted agricultural economic relief for farmers. It's for the members who had hurricanes or wildfires or tornadoes or floods and want disaster aid. And a bunch of other members who had a bill that they wanted to see enacted, whether it's a measure to try to crack down on hidden fees by hotels, that's in there. There's a wide variety of measures in here because when you get pushback from a number of members, you need to say, this is going to be bipartisan. We need a large base of support. What can we put in this bill to get your support? And so there's a lot of input, and they're banking on Republicans and Democrats having something to vote yes for, even if they complain about the broader nature of a 1,500-page measure coming to them 2 days before a shutdown.
Well, so then the next question is going to be when they'll have the chance to vote yes or no to this, Jack. Speaker Johnson just yesterday was saying, I want to stick to the usual process. I want this to go through the Rules Committee, give everyone 72 hours to read this massive, massive bill. How is this actually going to go down?
This 72-hour rule seems unlikely now. There's not an official plan of action in the House. I spoke to Mark Amadei, who's a senior member of the Appropriations Committee yesterday, who said, in his opinion, the obvious route is you skip the Rules Committee. You don't give people 72 hours. Maybe they can get 2 days. It came out last night. We'll see exactly when they hold the vote. But you do this under what's called suspension of the rules, which means you skip the Rule Committee and you need a 2/3 supermajority to get it through, rather than the simple majority in the House. There is a lot of bipartisan interest, so it seems like something that could get 2/3 in the House, and that would speed things up. Then, though, you have to get it through the Senate, and that will require unanimous consent on some procedural step. So if anybody really wants to slow this down and cause a shutdown, they can. It's a question of who that member is and what the mood is in the Senate. And I will say, members usually want to get out of here and go be with their families ahead of Christmas. So we'll continue to see if anybody wants to play the Grinch in the Senate.
Those jet fumes, a very powerful thing. So even assuming that all of this gets done this time around, the government does not shut down right before the holidays, we get our Christmas miracle in that regard, Jack, then it becomes a question of March, because that's how far the can is getting kicked down the road, until March 14th. Given how difficult this seems to have been, how much harder is it going to be in March when Johnson, assuming he stays Speaker, is working with an even smaller majority?
That's a great question. It could be harder because of the smaller majority, but it could be easier because, one, Republicans, when they're in the majority and they have the trifecta, have a very clear leader. What the then president, now president-elect, Donald Trump, says is the rule for Republicans. So if they're trying to wrangle votes and trying to get members who are tough to get on board to vote for a piece of legislation, if Trump gets involved and says, absolutely, you need to support this, or we're going to send people after you to run against you in your primary, that's a better motivator than they have right now when they're just asking them to kick the can down the road. If you can get Donald Trump and Elon Musk and Vivek Ramaswamy, who are not being helpful to Mike Johnson right now, to all work in the same direction, then they can have a better organization in March, potentially, than they do right now.
Well, one thing we do know for sure, Jack, is that Matt Gaetz will not be taking part in the next Congress. He already resigned from this one. And we did get a piece of reporting today around Matt Gaetz and the ethics investigation into him. Apparently, the committee did secretly vote to release that report, even though he is no longer a member. What do we know in that regard, and what precedent would it set if they do release the Gaetz report after he has left the chamber?
There is an ongoing debate about the degree to which this would set a new precedent. Representative Sean Casten, a Democrat who'd been pushing for this report to come out, has said that there are cases in which a member has resigned while under investigation, in which they've put the report out, and they don't want to set the precedent, in his argument, that you can avoid accountability and scrutiny by stepping down right before a report comes out. Ultimately, this is up to a vote. It takes a majority vote on the committee. We don't know yet which Republican voted in favor of putting this out. I think more information will come out about exactly where people stand, but you can see that Gaetz is preparing for it. He went on X and was posting about working hard and playing hard in his 30s, saying he did not do anything illegal. He did say that can be embarrassing, so this is not ideal for him, but obviously his course of defending himself and saying that he did not do anything legal will continue, and at least there's a little bit of convenience to him that if you want to bury this news, doing it right before the holidays is probably the time.
All right, Jack Fitzpatrick, Bloomberg Government Congress reporter, live from Capitol Hill for us today. Jack, thank you very much. And we do have a little bit of news coming from Congress right now. The other must-pass piece of legislation that needed to get done before year-end, the National Defense Authorization Act, has just passed the Senate after passing the House last week. The Senate voting 85-14 to send that $884 billion package to President Biden's desk. It's assumed Biden will sign it. The question is going to be when Biden gets a chance to sign this continuing resolution. I want to stick on this Matt Gaetz thing, though, as I assemble our political panel. Our signature one at that, Rick Davis, Stone Court Capital partner and Republican strategist, alongside Jeannie Shanzano, senior democracy fellow at the Center for the Study of the Presidency and Congress and Democratic strategist. So when we contend with the prospect of this Gaetz report, which I know all three of us have been dying to get our eyes on for a long time now, being released in the coming days, Rick, I do have to wonder, considering he is no longer a member of the House and has withdrawn his name for consideration for Attorney General, what will the ultimate impact of this actually be?
Well, there is a current underneath a lot of this in Capitol Hill where people think he's going to show up next year and get sworn in because he did get elected to another term. So even though he resigned his former term, he is still eligible to take his seat. And it wouldn't surprise me that part of the motivation of the Ethics Committee is to release this report to ensure that he doesn't change his mind and show up and get sworn in as a member of the 119th Congress. And so when those possibilities exist, people try to take some risks in order to stop these kinds of things from happening.
As if he can hear us, I just got a fundraising email from Matt Gaetz that hit my inbox talking about how help is needed. He's in the fight for his life, defending his name and honor. Jeannie, he says, instead of spending a wonderful Christmas holiday with my family, I'm forced to fight to defend myself. If he's still fundraising, that does lead me to believe he does have future political ambitions that he's thinking about deploying cash for. And maybe it's ultimately that, say, a gubernatorial candidacy in Florida that this ethics report will matter most for.
Yeah, that's right. I mean, this is somebody who has spent his entire life in politics, his adult life. And, you know, it's hard to believe he would be removed from that of his own accord. And so we certainly think he wants to get back into it, even though he had to withdraw his name, or he decided to withdraw his name. And his response on X about this report that is coming out is long, and it is very, very telling. Like Taylor Swift, he talks about this as, you know, activities that were in a different era of his life in his 30s when he was working hard and playing hard. He admits to things, although certainly not anything criminal, but that are very unbecoming of somebody as a member of the House and a member of Congress. And so I think the release of this report is going to underscore for many people that this is somebody who, if he chooses to run again or tries, to Rick's point, to come back to Congress, which I really doubt, they're going to have to raise serious questions about that. This is somebody who admits to things, again, not criminal, but that are very, very telling about who he is.
And of course, all of these concerns percolating around past conduct and character around Matt Gaetz are why he is no longer an active nominee for the second Trump administration, never even got to a hearing. And Rick, we've been wondering if any other nominees might meet the same fate in pulling a Gaetz, if you will, of withdrawing themselves from nomination before they can risk being voted down. One of the nominees we had greatest concern about, perhaps earlier this month, if less so now, is Pete Hegseth, who's been tapped to be the next Secretary of Defense. And according to CNN, Senator Roger Wicker, who of course will lead the committee hearing, says that hearing is set for January 14th, so almost a full week before Trump takes office. How much drama could that bring just 6 days before Donald Trump takes his oath at the Capitol?
Yeah, I think it's going to add an element of scrutiny on Washington that this time of year during a inaugural period is usually just happy, happy, joy, joy. That hearing will not be happy, happy, joy, joy. The biggest hurdle that Hegseth has is he's made representations to the senators he's meeting with that the stories about him are lies, and that he has reformed his drinking, but that the relationships discussed in the public domain aren't true. If in his FBI report those things become more factual, he's going to have a hard time explaining why he said things were untrue when they came back and an FBI background check is becoming fact. And so that is his vulnerability in that hearing, is members bringing those things up and asking him those questions directly.
So, Jeannie, what do you make of the timing, this January 14th date? I fully understand trying to get as much of the cabinet in there as possible so they can be ready on day one when the president moves into the White House. But Pete Hegseth, one of the first to go, at least at this point?
Yeah, I mean, you know, it does make sense. I mean, we do need a Secretary of Defense in place. So, you know, the world is fraught with a lot of challenges for the incoming administration. They should be ready. But, you know, to add another element to what these hearings on the 14th can bring about, we heard Lindsey Graham over the weekend saying, you know, the reason he's supporting Hegseth at this point is because those allegations against him were anonymous. And, you know, to Rick's point, do they come about in an FBI check he's forced to answer to? But also imagine now he has apparently released this woman who made these allegations against him from her privacy, their privacy agreement. And imagine if she decides to come forward or doesn't decide, is called up. We could have really, really difficult hearings for Pete Hegseth and his family at that time. So, you know, these would be Kavanaugh-like, these would be Clarence Thomas-like, if indeed you see a witness like that come forward, which is very, very possible since he has said, or his lawyer has said, she is now released from their agreement to maintain privacy.
We just have a minute left here, Rick, but we've discussed the continuing resolution that was released last night, the fact that Elon Musk and Vivek Ramaswamy are not happy with it. Elon Musk just putting out a new post on X that says, the more I learn, the more obvious it becomes that this spending bill is a crime. He's not being shy here, Rick. Do you think anyone will be heeding his voice?
Yeah, typically in Washington, when you stick your neck out that far, it gets chopped off. And he's way too new to this game in the sense of, you know, having this sort of public posture as the head of Doge and the Trump whisperer for all intents and purposes for the last month to really get that far out in front of this. Now, I get it. It's his brand. But does he back Donald Trump into a position of calling up Johnson and saying, you know, we're not going to pass this bill? I mean, like, there are real serious consequences to this kind of behavior. Yeah. I would have said absolutely no chance that this bill could be interrupted at this stage. But if Ramaswamy and Elon Musk launch a campaign against this bill, they might be able to get Donald Trump to throw it under the bus, and we could have a serious government shutdown right before Christmas.
All right, Rick Davis and Jeannie Sheehan Zaino, our signature political panel. Thank you both so much for joining me on this early edition of Balance of Power, and we'll have much more in the late edition at 5 p.m. I'll be joined by two members of Congress from both sides of the aisle. Democratic Congressman Jake Auchincloss of Massachusetts will be with me, as well as Republican Congressman Ralph Norman of South Carolina, who has already said he's a no on the continuing resolution. So that's coming up at 5 o'clock. Before we get there, though, I do want to bring it to your attention to something starting at 4:30 p.m. Eastern Time in the hours after the Fed's final rate decision of the year. You can hear Bloomberg Economics' team and join them for a Bloomberg Live Q&A at Bloomberg.com. Again, that's starting at 4:30 p.m. Eastern Time. A team of expert reporters will answer your questions, so make sure to tune in.
It's 121 on Wall Street. We do check markets all day long here at Bloomberg. I'm Charlie Pellet, and we now have just about 39 minutes to go until the FOMC decision, 2 o'clock Wall Street time. We're set with complete coverage coming up minutes from now on Bloomberg Television and Radio. Here's where we stand in terms of the equity markets. Higher right now with the S&P up 11 at 6,061. That is a gain of 0.2%. Stocks have been swinging between modest gains and losses. The Dow up 125 now, up by 0.3%, while NASDAQ is higher by 53. That is a gain of just about 0.3%. The Russell 2000 index of small cap shares up 0.4%. The 10-year 4.38%, with the 2-year 4.21%. Gold now down 0.4%, 26.37 the ounce. West Texas Intermediate crude close to 71 a barrel, 70.90 right now on WTI, up by 1.2%, and a retreat today for Bitcoin at 104,700, down now by 1.6%. After earnings, General Mills down 3.6%. After earnings, Birkenstock up by 6.3%. After the close of trading, we will be hearing from Micron Technology. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. Balance of Power continues. Back we go to Washington once again. Your host, here she is, Kaylee Lines.
All right, Charlie Pellet with a look at the trading ahead of the Fed's rate decision. Thank you so much. That decision, of course, coming just about 37 minutes from now. It's their last one of the year, and we are expecting, at least the market is, for the third month in a row for them to deliver a rate cut. The expectation is 25 basis points. But it's future meetings next year, when Donald Trump will be back in office, that are raising the bigger question here, and why everyone will be eyeing the dot plot and heeding the words, or at least parsing through each and every one of the ones that Chairman Powell will speak at the press conference 30 minutes after the decision is released. So we want to get more into the expectations here and what exactly economically 2025 could bring, and turn to Joe Livornia. He is chief economist with SMBC Nikko Securities America. He also was the chief economist at the National Economic Council during the first Trump administration. Joe, welcome back to Bloomberg. Happy Fed Day to you. Thanks for being here. I guess first questions first. Do you see justification for a 25 basis point rate cut today?
I don't. The economy is held up well. I think a lot of it's government induced, but be that as it may, the economy is held up well. It looks like current quarter GDP could be over 3%. We've had inflation way above target. The Powell Supercore is running over 4%. It seems to me that the Fed is stoking potentially some excessive risk-taking in the market. So I would prefer that they had not cut in November. I don't see the justification for December. Having said that, they will wind up cutting.
Okay, so if they do deliver it, do you think that's sowing the seeds for a reacceleration in inflation just when they were getting close to that 2% target?
It's possible, because the problem is the Fed had, they raised rates aggressively because they were way too slow in hiking. We had excessive demand side stimulus. And when they cut in September, it was based on the fact the labor market at that point looked really, really soft. To me, the labor market isn't great, but it's improved. And what's happened is financial conditions now have eased massively. So the problem with the Fed easing further is they may just further stoke an easing of financial conditions. It's not just the booming equity market, but it's also rising home prices, it's generational lows in credit spreads. So those are the concerns that I have. The Fed could just make the situation worse by effectively adding, the proverbial more fuel to the fire.
So you think the booming equity market is more to do with expectations around monetary policy than, say, expectations of Donald Trump taking office in January and everything that will bring?
No, I don't believe that to be the case. I think the Fed has to be much more careful about the money supply and credit creation. We've seen M2 growth accelerate in the last 3 months to almost a 6% rate. The small caps and the financials in certain sectors are very enthusiastic about President-elect Trump coming back. We see that in a small business survey where you've just seen massive, basically vertical jumps in things like good time to expand and expectations the economy improves. No, I just think this is a part of a bigger narrative where the Fed just has not done a very good job signaling its intentions and has been wrong-footed many times on inflation. And I'm just worried in the short term, by the Fed easing more and potentially getting more money in credit creation, they make a potentially sticky inflation problem worse.
Well, Joe, you and I have had several conversations about the future of inflation and the role, if anything, tariffs could play in that. I know you see higher tariffs as effectively bringing a one-time price increase. They should be viewed holistically with everything else economically the president-elect would like to pursue. But I guess my question for you is, how do you think the Fed views it? If it is a price increase they ultimately see, what is the reaction function for monetary policy?
I'm happy you raised that question, because I think I'm very bullish on growth next year. I think inflation will moderate, because I see President-elect Trump's policies as expanding the supply side of the economy. Its potential, productivity, basically, its ability to produce the things that we want. However, I think the Fed has taken a much more demand-side Keynesian approach. They view the inflation process as not really a money and credit phenomenon, but rather where the unemployment is relative to NAIRU, or where the output gap is. So that, my fear is that they're going to look at a tariff increase as being inflationary when it's not, and when they should maybe be easing next year because productive output increases. Instead, they hold pat, and that would obviously set in motion a negative reaction in markets in the broader economy.
Well, and when we consider the global economy, there's also the consideration on not just what tariffs mean for higher prices in the U.S. potentially, but also if we are seeing higher tariffs and it results in a, if not outright decoupling, a lessening of the trade relationship between the U.S. and China, the world's two largest economies, what the wider economic ramifications of that could be, not just here at home.
Yeah, I'm not worried about that, because I think you've already seen when President-elect Trump talked about 25% tariffs on Canada and Mexico. There were quickly talks where both respective leaders either went to see President Trump in person or had conversations shortly thereafter, as reported in the news. So I think, again, this is a negotiation. Tariffs will be a very powerful, important tool that will be used. I just think it's incorrect to look at them as being inflationary, which I think some on the Fed will look at, and I think that would be a monetary policy error, especially if we're cutting regulations and oil prices and energy, more broadly speaking, falls. That's where you can get some real improvement on the pricing side, because you got these second and third order effects when energy prices fall, the inverse of what we had when inflation surged back in 21 and 22 when oil prices were higher. You'll get the opposite.
Joe, finally, I want to ask you about something else in the news today, which is that we got the text last night of a mammoth government funding continuing resolution, that there's been a lot of pushback from Elon Musk. Vivek Ramaswamy don't like this. Now the president-elect's son, Donald Trump Jr., says the American people didn't vote for this. They voted for the opposite. They voted for transparency. This cannot pass. Just quickly, Joe, if we were to somehow stumble into a shutdown here before the holidays, do you expect it would have a real economic impact?
No, I love the fact that we're trying to get rid of this pork barrel legislation, and we're actually trying to do something productive that's a bipartisan issue. I don't look for the government to shut down. I think ultimately the government will be open around the holidays, and I'm hopeful that whatever we get on the budget resolution, it'll be basically pushed to next year, where a more comprehensive, better formed bill than probably what's out there right now, what it comes out as. In other words, I like what's happening. I think it's important. We have to have this discussion.
And we still have a minute left here, Joe. So if you could ask the Fed Chair, Jerome Powell, one question in the press conference today, assuming that what they do deliver is a 25 basis point rate cut, what would it be?
Well, I would like to get some more information on where the Fed thinks it's, neutral is, and how they compare that to where financial conditions are, because monetary policy has not tightened effectively for most of the economy. We've seen basically the cost of capital fall quite dramatically because of the rise in equity prices and very tight credit conditions. So why are you easing policy when you could just wait? And why are we so worried about what investors who are betting on in the Fed funds futures market, why are we so worried about disappointing those expectations? Wouldn't it be better if policy was perhaps a little bit more two-way on the risk? Why is it that investors can't lose money sometimes, or why can't they be disappointed on where monetary policy wants to go? I don't understand that. I think the Fed has done a really terrible job of setting policy in a way that's led to major misallocations of capital, because they believe that they can't let Wall Street down. And I think that's ultimately very unproductive, and I worry that if the Fed does cut today, as they likely will, you actually might get a more negative reaction ultimately in the bond market than had they just not cut and let the market kind of evolve, as I think it will in a positive fashion. But I first want to see inflation go lower, and the Fed should do that.
All All right, Joe Livornia, thanks for joining us here on Bloomberg TV and radio. He's chief economist with SMBC Nikko Securities America, former chief economist at the National Economic Council in the first Trump White House. That wraps things up for Balance of Power. I'll see you in the late edition at 5 p.m. And in the meantime, a special edition of Bloomberg Surveillance, The Fed Decides, with Tom, John, and Lisa in New York starts right after this.
Live from New York City, live TK, for our audience worldwide. Good afternoon. Bloomberg's The Fed Decides starts right now.
This is a special edition of Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Bloomberg Surveillance, The Fed Decides.
This is the one you've been waiting for, the final Fed decision of the year, 2024. A news conference 30 minutes after that. That decision, Bramo, 27 minutes away.
The expectation is for a hawkish cut, 25 basis points of a cut, but leaning toward next year being fewer cuts than they had previously penciled in. I just want to point out, if they cut 25, 100 basis points of rate cuts have happened just in September.
TK, the consensus seems to be you cut at this meeting, but at the next meeting, you take a skip.
I agree. Sorry I interrupted you. The eggnog's just clicking in. I look, John, at what we have, and I just put this out on Twitter. This is not a snooze fest. I'm looking at the foreign exchange market. I'm looking at real yields, and there's more going on here than the consensus boredom.
Look, if we cut today 25 basis points, and overwhelmingly that's the consensus for 2 p.m. Eastern time, that's 100 basis points of cuts across 3 meetings. When they were talking about recalibration, when this cutting cycle first started, is that what they were talking about? Are we really entering a different phase?
It's a real question that Fed Chair Powell has to answer at a time where he has continually seemed to want to lean into the idea of ongoing cuts. I will just point this out. On September 18th, the day of the 50 basis point cut, 10-year yields closed at 3.7%. Today, they're almost 4.4%. That is saying something.
Atlanta GDP publishing 2 hours ago, 3.1% is their working statistic on GDP. Nothing else has to be said.
The data's looking pretty good. We'll talk more about the data in just a moment. Let's check the price action going into this Fed decision. Equities at the moment on the S&P 500 just about positive by 0.2%. The stat you're all looking for, though, how many stocks are advancing, Lisa, versus how many stocks are declining? Are we finally breaking that bad streak of bad breath?
Today seems to be that type of day where maybe we break those 12 days. We have had 12 straight days until today where we had more stocks losing than gaining, and that might be set to break today.
In the bond market right now, yields declined just a touch on a 10-year at the moment, 439.28. At the front end of the yield curve, Bramo, the 2-year down 2 basis points, 422.
Coming up, we're going to be speaking with Ellen Zentner of Morgan Stanley and Kathy Jones of Charles Schwab. They will be taking us up to the big event, the Fed rate decision at 2 p.m. Eastern. Then, as we wait the countdown clock until Fed Chair Jay Powell gives his press conference, Diane Swank will be joining of KPMG and Deutsche Bank's Matt Lazzetti. And finally, as we see the purple tide, I'm not talking about Tom Keene's bow tie, breaking down Chair Powell's news conference, Sarah House of Wells Fargo and Jeff Rosenberg of BlackRock will be joining us, John. And I agree with Tom. This is not going to be a snooze fest.
Matt Lazzetti at Deutsche Bank thinks after this, on hold through the whole of 2025.
Did he really say that? Hold?
Matt Lazzetti thinks you get a cut today and then they're on hold through the whole of next year. Look out for that conversation a little bit later. Starting the conversation, Bob Michael of JP Morgan Asset Management joins us around the table. Bob, good afternoon. It's good to see you.
Yeah, happy to be here.
What are you expecting in about 25 minutes' time?
You know, this was meant to be a good meeting for them where they could high-five each other, open the champagne. No matter how you look at the data, they've glided to a soft landing. It's everywhere across the data, but that's not going to be the case because they know there's going to be policy changes coming in the next year. They don't know how they're going to be sequenced, and they don't know the magnitude of them. So it's going to be quite a meeting behind closed doors.
What's the signal to you that on September 18th, when we initiated what will be potentially 100 basis points of rate cuts in just 3 sessions, the 10-year yield closed at 3.7%. Today, it is 4.4%. What is that telling you?
I'm taking the other side of that. I've been shocked how stable this market has been. If you go to November 4th, the night before the election results, the 10-year was 10 basis points lower. The entire yield curve was 10 basis points lower. So you've gone through an entire sweep of government, constant talk about fiscal stimulus, and a whole load of things that could lead to higher inflation, and the yield curve has hardly budged. That tells me we should have been at 5%. We're not. There's a lot of dry powder that comes into this market on every backup.
Economist Charlie Gasparino over at the New York Post suggests that Mr. Diamond has been speaking to Mr. Trump. That was news a couple weeks ago as well. Is any politics tinged into this meeting today? Usually December, sort of, let's get through it, but this is a wild political season. Is there a politics to the press conference?
I think there has to be. We went back and looked at this meeting 8 years ago, and we went through the minutes. And they did acknowledge that they discussed the incoming administration. Back then, a lot of the talk was on deficit fiscal spending, a lot of stimulus coming through that. They know there are going to be policies on deregulation. There's going to be tariffs. There are going to be immigration policies, things on taxes. For sure, they're going to talk about them, and they've got to start thinking about how they model them.
So this, to me, is the real question, how potentially Fed Chair Jay Powell could say something other than just simply, we'll wait and see what things are and react to them accordingly. Could he potentially give a scenario analysis? Do you have a scenario analysis of what bonds do if there are certain policies implemented in Trump's cabinet?
I think a lot of people who are calling for no cuts next year are going to be frustrated because we spent a lot of time, including this morning, looking at just how things could be sequenced. Simple things like deregulation. Well, actually, they're not so simple. You have to put together a subcommittee, have a chair, they have to do their research, make a proposal. We went back and looked at the first years of Reagan. Remember, he came in and he was going to deregulate, and he forced the Justice Department to hand down decisions on AT&T and IBM. That still took a year before that happened. So I think the Fed is going to leave some optionality open, but they're going to go back to the data. Let's see how the data plays out. We're in a good place right now. We've done a lot. Let's see how that works through the system, and we'll see what comes out of the administration.
John, I'm going to go to you transatlantic here. I mean, they got Germany flat on its back, France on its back. I read like utility bills and stuff in London. It's absolutely nuts over there. Does the European slowdown fall in this meeting? I have a habit of looking Pacific Rim, but does Lagarde in Europe and the Bank of England, do they fold into this press conference?
I don't think it's on Chairman Powell's radar right now at all. The backdrop for the rest of the world is awful. You talked about Europe politically, France, Germany in a lot of trouble. I'd throw China into the mix as well. I think we need to be talking about what's happening with the Chinese economy and the Chinese bond market. We talked about this earlier this morning on Bloomberg Surveillance. The chart of the year for us is this dive in Chinese bond yields, which have just rolled over aggressively, particularly over the last few months. What is the signal coming away from the rest of the world about economic growth?
The rest of the world is struggling with much lower growth. They're struggling with the price increases that they've seen over the last couple of years. They don't have the stimulus of the magnitude that we've seen in the U.S. So their central banks are looking at ways to respond to that with more aggressive rate cuts. You're right about China. That continues to slow down.
When you think about what's on the table right now in fixed income, where do you want to be with all of that in mind? Europe not doing so well, China in trouble, the U.S., it feels like better than the rest.
Well, I think there are still some pretty good yields across the U.S. bond market. The Treasury curve isn't the U.S. bond market. It's just the Treasury curve. There are things to do in credit. Yes, we continue to like credit. There's no recession on the horizon. Any backup I would love to see will be in buying. We're also looking at the market that offers the highest reward per unit of risk. That's emerging market debt. There are things to do in those oversold markets in both the external and local markets.
I'm looking right now. You can get some hot CCC rated bonds for a spread of 5.37%, percentage points over benchmark rates. Look, everyone's been saying this, and this has sort of been the consensus trade. And I wonder, as you look around the world, yes, maybe there are attractive yields in the U.S., but you're not necessarily going to get those rate cuts. How much has your enthusiasm shifted away from the U.S. on a relative basis toward places like, say, Europe, which seems to be flat on its back?
Yeah, it's a good place to pick up duration. You get some anomalies where you've got France converging with Italy. We didn't think we'd see that, so that creates some opportunity. Growth is slowing down, but the corporate bond market still looks okay there. I'd also just want to point out that today's CCCs are tomorrow's BBBs. So there is a ratings migration underway.
Hold up, Bob Michael. You buying CCCs? You like the junkiest of junk?
We have been buying CCCs, and they have played out very well for us. And I'm sure when I was here a couple Fed meetings ago, I did mention that in September.
That spread has a 5 handle now. It had a 9 handle back in the summer. Amazing compression over the last few months.
I just wonder what Bob said, that today's CCCs are tomorrow's BBBs. I expect a hat with that, make CCCs great again on the T-shirt. And you just have to wonder why, right?
Yeah, I just call it American exceptionalism, and you see, it sounds like Dan Fuss 101, credit upgrades. I mean, that's what you're talking about.
Looking for more of the same through the next year. There's a lot of bullishness out there. Bob Michael at JP Morgan, sticking with us. Up next on the program, Ellen Zentner of Morgan Stanley alongside Kathy Jones of Charles Schwab. From New York City, that Fed rate decision is coming right up.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Names that move markets are on Bloomberg.
Our budget proposes an additional $3 trillion of deficit reduction over 10 years. And I think that's necessary to make sure that our fiscal path is sustainable. Now, Congress hasn't done anything, beyond what I've mentioned to improve the fiscal outlook, and I think that's a shame.
Nobody covers business like Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, weeknights at 8 p.m. Eastern Time, right here on Bloomberg. Context changes everything.
The expectations going into this FOMC meeting are that, yes, there'll be a 25 basis point cut.
People are setting up for the potential for the Fed to sound hawkish.
He's going to be setting the stage for a pause at the January meeting.
Markets are very certain about December being a cut, and they're pretty certain about January being a pause.
They're going to wait and see what the Trump administration wants to do and if those policies are inflationary.
Powell is going to be sticking to this idea that we don't guess, we don't speculate, and we don't assume.
We are looking for a Fed that remains very sensitive in terms of the economy.
He's going to be relying on this idea that the economy is in a good place. Inflation also has been a little bit stickier.
If you look, it hasn't really broken out of any kind of long-term range.
The Fed can surprise dovishly here.
Powell, who always likes to surprise us, He may have another surprise in store for 24.
We'll see. 15 minutes to go until that decision. 30 minutes after that, we get a news conference with the man himself, Chairman Powell. Into all of that, here are the scores. Equities at the moment on the S&P 500 this afternoon shaping up as follows. Up 0.1% on the S&P, up by 0.5 on the small caps. In the bond market, 2-year, 10-year, 30-year. Your yield curve shaping up as follows. Bramo, yields just a little bit lower, down about a single basis point on the 10-year. It's a break of 440 to the downside.
Yeah, but we have made such a huge move since September 18th when we first cut by 50 basis points. The fact that we were there at 3.7% highlights a key question. Is this a market that basically is coming around to a stickier inflation that Jay Powell has to reflect?
Those higher bond yields have been feeding some real dollar strength through the year so far in G10 and against EM. Euro dollar right now just about holding on to 105, 104.91. Joining us around the table, Ellen Zentner of Morgan Stanley alongside Bob Michael of JP Morgan. Ellen, it's good to see you. Let's talk about this decision in about 13, 14 minutes time. Three-part act. We get the decision, we get the forecast, then later we get the news conference. How are you expecting the forecast to change in a few moments' time?
Yeah, so I think the forecast, look, the Fed always has to mark to market for what's happened in the economy, and is there anything that's changed their opinion about the future? So look, growth is stronger. Unemployment rate is a little bit lower than where they thought it would be, even though we've had the pop-up more recently. And inflation is stickier. And so you put all that together and you shake it up and put out your new 8-ball, right? Your magic 8-ball.
You use an 8-ball?
And it tells you, I do, Tom. That's how I've been so accurate over the past couple of years, right? It's one step better than...
The career's built on an 8-ball, TK.
Yeah, it's one step better than licking your finger and sticking it in the air.
It's a Keynesian 8-ball.
Yeah, so, and what is that going to tell you? That they probably, if you had an idea you were going to cut 4 times next year, probably one less cut, you know, but is it really going to matter? Because Chair Powell will say the usual, that the forecasts mean nothing. It's a fun exercise for everyone to mark down something on paper, and who knows what we're really going to do.
You said something back, it was back when Tottenham was supposed to win Premier League, where the basic idea is the consumer's on fire and the halves of the consumption are really, really on fire. I got an Atlanta GDP now of 3.1%. Are the halves of America, are they supporting us? And is that in the calculus of the Powell press conference?
Well, so Powell often gets asked about, at least at conferences often, what about the inequality among the consumer sector? I don't like having all our eggs in one basket, and the wealthy consumer is propping up aggregate demand overall, carrying more than their fair share. And so really the question is, which the Fed can't answer, what gets the wealthy to stop spending? That's a risk for the outlook. But the Fed deals with risk to the outlook just as us economists all the time. And the risk, of course, is if the wealthy stop spending, it's generally a very big loss of wealth and broad white-collar layoffs. You don't really see either of those on the horizon. And so it's not something that really the Fed builds into what might happen next year. What they know is that the data point to strength is probably going to continue. The economy is doing okay. We've done some cutting here, and we can probably pause, but we're not sure. We're just going to watch the data, but it means we probably don't need to keep going every meeting.
To build on what you're saying, people who are wealthy, who have money invested in the stock market, feel great this year. They feel really good. They've gotten a lot of money, and
Bob
the
feels
wealth
especially good.
Bob is doing wonderfully, and we'll get to
People are putting money in bonds too. Not just equity.
That's
okay with that.
Right. Good plug. But there is this sense that the Fed doesn't necessarily consider markets that much anymore. Financial conditions, they still talk about them being restrictive, even with record highs, 57 record highs, I believe, on the S&P 500. At what point will that be something that they consider as a reason why this can either continue or maybe overheat?
Well, I don't think you're going to hear Chair Powell today say that financial conditions are tight, because really you can't, there's hardly a segment of the market where you can point to and say conditions are tight. I mean, for lower income, lower credit quality borrowers, are conditions tight? Absolutely. But broadly speaking, if you take a holistic view of financial conditions, they're not tight at all. And that was certainly those that don't want to keep cutting on the FOMC can use that as an indication that, you know, yes, we think that there was ample room to cut. We've cut 100 basis points. And so as they get into that January meeting, you know, how much further do we need to go? I mean, financial conditions, come on, they're pretty easy.
Isn't housing still a big problem for them? New and existing home sales are still way down down there. Home prices are high. Mortgage rates are still too high. It's killed the first-time home buyer that's dying to get into the market.
Exactly, but the issue there, Bob, so, you know, we always say as economists, so goes housing, so goes the business cycle. And so, but housing for the majority of homeowners, right, locked in at very low mortgage rates, housing has been phenomenal for them. And yes, there's a lot of pent-up demand for selling, and people don't want to sell because they don't want to get a new mortgage at a higher rate. And it does create those issues for new home buyers. But they still have to go out and spend in the economy, and because it's really, how does housing impact the economy broadly? It's through home valuations. And of course, this is a dynamic that supports home valuations because there's no inventory. And so for the Fed, I think more of their issue is going to be when do mortgage rates respond more to sort of the path priced in for the Fed, that the Fed's going to keep dropping rates, mortgage rates come down. You're going to have a surge in selling, a surge in buying that's going to constantly meet and kind of keep that soft landing in place. I mean, this just continues to support the soft landing thesis, the housing market that we have.
Just to unpack some of this, it all feeds into a bigger debate they'll be having at the Federal Reserve both yesterday and this morning, no doubt. The neutral rate, just where are we and where is it? The market seems to be close to 4. The committee seems to be closer to 3. Do you think we closed that gap today?
I always think the neutral rate is cycle dependent. In the cycle we were in November 4th, I think it was closer to 3. In the cycle we're in today, with the prospect of a lot of stimulus coming, things like tariffs and immigration policy, which could raise costs, I think 4% looks to me to be.
You think the election changes the story that much?
100%. Everything changed.
Do they begin to respond to that at today's meeting with these forecasts?
I think, again, looking back at 2016 minutes from December, they start talking about it. They can't have their heads in the sand. Right, Ellen? You were in the room.
No, absolutely. So, look, I completely agree with Bob. And even if you're not thinking about it cyclically, you think about what depressed neutral rates, right? So since the financial crisis, a lengthy period of deleveraging among households, other structural factors that were holding down neutral rates, that is gone, right? We don't have a balance sheet recession. We don't have balance sheets weighing on longer-term neutral rates. And so what you've seen is that the Fed has been raising its estimate of the neutral rate for some time now, but you've got 19 people with different opinions, and it's a slow-moving beast, but the direction of travel is clear. And so you've got, it's drifting higher, and you've got folks at the high end of that, like a Tom Barkin, that believes that it is closer to 4%. And look, we're kind of closing in close enough to there that they can start to kind of slow down and see where we end up.
Let's bring in Kathy Jones to continue the conversation, joining us from Charles Schwab. Kathy, welcome to the program. You've been hearing the debate from the panel around the table. Do you agree with a lot of what you've heard?
Yeah, I do. I think the big issue facing the Fed and facing the market is what we don't know about policy going forward. And that puts the Fed in a difficult place. They can do scenario analysis. They can start to talk about it, but they can't really take that much action yet until they know what those policies will be, when they'll be implemented, how, what the magnitude of them is. So I think they do sort of take a pause after this rate cut and reassess. I'm going to be very interested, though, to see whether there's a dissent. Will Mickey Bowman just say, I was not 100% on board last time and I'm really not on board this time, or whether, Powell will be able to get a consensus.
It comes at a time where we've got 4.4% basically, but plus or minus, on 10-year yields. And I just wonder whether they'll talk about some of the borrowing costs and some of the deficit and how that might affect what term premium looks like going forward.
Yeah, we've got the term premium being kind of a major driver of long-term rates in 2025. And clearly there's room for it. I think a lot more room for it to go up than down from here. That, informs us. Right now, you've got a 10-year yield about 4.38. That's kind of pricing in a 3.5% Fed funds rate, give or take 3.5, 3.75, based on kind of long-term relationship. If that proves to be the case, this yield is not all that bad. We think, though, there's more upside risk than downside just because of the policy uncertainty and the fact that that could be reflected in the term premium moving higher.
Kathy Jones, where does the 10-year real yield indicate a true restriction? We've gone 155, 160, up above 2% now, 2.05% right now. Do you have a level in your head where the real yield says we're restrictive?
Yeah, I would think it'd be closer to 2.5% because it historically, well, it depends on which cycle in history you want to compare it to. But, 2.5% real yield has been something that has slowed things down in the past. But this could be a very different cycle because of the fiscal policy side of things. So I can't say that's the absolute top, but I'd be very surprised if it gets too much above that.
Michael put his hand up and said, Tom, talk to me nominally. Arif Hussein over T. Rowe Price made some headlines, I think, 2 days ago. What if we get to a 6% yield? If we go away from your vector and we do break out to some form of higher yields, when does the pain click in on a nominal basis?
Oh, I think above 5%. I think
5%.
Yeah, I think the interesting thing is here, Ellen, Kathy, and I are all out talking to clients every day, largely in the wealth management channels, and I'm sure they've had the same conversation I've had, which is, I have too much cash, money market yields are coming down, where do I get into the bond market? Sometimes it's munis, sometimes it's in things like income funds or opportunities funds, but there's a lot of dry powder out there that will look at 4.5% to 5% as an opportunity to get in.
So you disagree that the term premium, that yields sort of have a greater risk of going up from here than down?
If they did, we would have seen it already. We would have been north of 5.
Do you agree, Ellen?
Yeah, I think, term premium, it is a weird beast to try to pin down. I think there has been a big argument for a time that the term premium should be higher, but how much of that gap have we already closed?
Kathy, I just want to give you a final word here on this debate. Looking ahead to next year, how many cuts are you expecting, and how many cuts do you think they signal in the dot plot today?
Yeah, we have 2 cuts priced in. I think they'll signal 3 for next year. That would be my guess.
Slowly closing that gap. Kathy, appreciate your time as always. Kathy Jones there of Charles Schwab, and a special thank you to Ellen Zentner of Morgan Stanley as well. That decision is about 2 minutes and 30 seconds away. This is a 3-part act. The first part, you get a decision in the statement. Any dissent, you'll find it there if we get any. You also get what's called the SEP, the Summary of Economic Projections. That's where all the forecasts are. Inflation, unemployment, growth. You'll find the dot plot there as well. Lisa, after that, it's over to the chairman. 30 minutes later, a news conference with Chair Powell.
And basically, we do not speculate, we do not guess, we do not assume, but at the same time, he's going to be asked, what are you basically modeling out? What is your response function? How inflationary could some of these policies actually be?
I use Kleinman moving averages. His intermediate moving average is 9 unit. It's out to a new high on the BBDXY. If you get a dollar breakout higher, Mr. Trump will pay attention to that. Mr. Bissett will pay attention to that. And even Ellen Zentner will pay attention to that.
I've got to say, TK, I'm pleased you brought this up. How Mar-a-Lago responds to this in the minutes and hours after this decision, I think will be pretty interesting.
Especially because it's a 2-part act there. On one hand, let's go. Let's get the engines revving up. On the other hand, inflation is the reason why Joe Biden lost. That's what a lot of people believe.
I spent 20 minutes before this using the Bloomberg. I even got to Hungarian forint. John, I know your place in Budapest. You cared about that.
Last year, I think down double digits against the dollar.
Yeah, for separate reasons, it really popped. But it's worth watching EM here.
Welcome back, TK. I've missed these conversations.
Just
going out there, bringing up Hungary. Do you remember those Swiss franc mortgages all those years ago?
Yeah, the Swissy foreign mortgages.
Who would have thought we'd be talking about this 50 seconds out from the decision? But that was a real thing. That was a problem in the day.
Actually, right now, there are nodes of that happening in different places. I mean, check out what's going on in Brazil.
And let's hope that Brazilians haven't been taking Swiss franc mortgages, because they've probably been in a lot of trouble after the performance of that currency this year. Let's turn to the scores. That decision is 30 seconds away. Equities on the S&P 500 positive by 0.2% on the S&P. Some outperformance so far this afternoon on the Russell. The small caps up by 0.65%. If you switch up the board and get to the bond market story, check out the yield curve. We'll slice this up on the 2s, the 10s, the 30s. Yields are coming down at the front end of the curve by about 3 basis points to 421.30. On a 10-year, we're down a single basis point to 438.29. With your Federal Reserve decision, the overwhelming consensus saying a 25 basis point cut. Here's Mike McKee.
It is a 25 basis point cut, and the number of cuts forecast for next year has been cut in half to just 2. Another 2 are seen in 2026 and 1 in 2027. And as the long-run Fed funds rate expectation rises to 3%. If that's basically seen as Fed officials' view of the neutral rate, they won't get there under this dot plot until 2028. We have one dissent. New Cleveland Fed President Beth Hammack casts her first, preferring to leave rates unchanged. Interestingly, 3 other members of the committee, presumably non-voters, agreed with her. 10 members see two cuts next year. 5 see 3 or more. 3 forecast 1. And there's 1 member who thinks optimal policy would be to leave rates unchanged all of 2026 and 25. There is only one change to the statement. They now promise to carefully assess incoming data, quote, in considering the extent and timing of additional adjustments to the target range for the federal funds rate. There's no change to the committee's view of inflation, which has, quote, made progress toward the committee's 2% objective, but remains somewhat elevated. The new economic forecasts, however, show both PCE headline and core inflation forecasts revised up significantly. Headline will be 2.5% at the end of next year, up from 2.1 forecast in September. The core also 2.5%, up from 2.2%. They do see unemployment at 4.3% at the end of next year, which is down 1/10 from September. The economy will end this year with GDP up 2.5%. That's a 0.5 percentage point jump from their September outlook, and it is going to grow 2.1% in 2026, a significant slowdown. In one technical note, the Fed did lower the offering rate for overnight reverse repurchase agreements by 30 basis points to 4.25%. That's the same as the Fed's target range lower bound. Guys?
Mike McKee, thank you, sir. There's so much to unpack here. So let's just go with 2025 and go to the forecasts. So we get a 25 basis point cut. And then they do this for 2025. GDP revised higher. Unemployment revised just a little bit lower. Then go to PCE. Once again, revised just that little bit higher. So what do you get for the dot plot? The median dot was actually pointing towards 4 cuts for 2025. They've cut that in half to 2. Which basically marks the whole thing to market. This is where the market was, looking for 2 cuts in 2025, and this is what the Fed is projecting, if you consider this a projection in the median dot. Turning to the price action off the back of this, we unlock another dose of dollar strength. Euro-dollar breaking down to 104.44 off the back of that move in the bond market, with yields higher at the front end of the curve on a 2-year up by 3 basis points to 4.28, on a 10-year up by a single basis point to 4.41. In the equity market off the back of that, we come off session highs. On the S&P 500, we are just about unchanged. So if you are just joining us, welcome to the program. It's a 25 basis point reduction from the Federal Reserve with a sprinkle of dissent and some big changes, Lisa, to the forecasts for 25 and beyond.
And what you can see is basically the market readjusting, but not necessarily a freaking out. I think it's fascinating, the idea that Beth Hammack, the new Cleveland Fed president, is the lone dissenter. 3 non-voting members, as Michael McKee said, seem to have agreed with her. To me, this is the definition of a hawkish cut. We now have 100 basis points of rate cuts since that September meeting. Now they seem to be only baking in 2 rate cuts, as you said, and it raises a question of what the parameters are, what the messaging will be from Fed Chair Jay Powell.
Compare the September forecast to the forecast we just got. Where they thought Fed funds would be at the end of next year is now where they think Fed funds will be at the end of 2026. They've pushed the whole thing out 12 months. Now, the debate we're going to have, and no doubt the debate they'll have in the news conference with Chairman Powell and the journalists, how much of this is about realized data, the data we've had since the September meeting, and how much of this is about assuming, speculating, guessing what's about to happen with policy?
Well, and ultimately, how much can they divorce the two if they're looking for signals from the collective betting agency, the collective wisdom of the crowds of markets? At a certain point, they have been following the market in certain aspects. And in this case, the market is inferring certain things about policies, and the Fed cannot ignore that. But I want to hear from Fed Chair Powell this afternoon in just about 25 minutes' time. What is your scenario analysis? How do you take into stride stride the prospect of both tariffs as well as potential changes to immigration.
To me, the character of the dissent's interesting. I don't have time to study it, but the uniqueness of, she's quantitative economics out of Stanford. She certainly knows her way around the block, but that's something. Your first meeting and you dissent? I mean, what would Alan Greenspan say to that? That's like Lawrence Meyer 101. But the answer here is the markets are moving. I'm looking at yen out to a 154 level. Damien would look at it 8 different ways, but the answer is this is not a snooze fest, and there's a lot going on here in a more than expected hawkish cut.
This is what they call a hawkish cut. I could not agree more, and that's judged by what's happening at the front end of the curve. Even as they reduce interest rates by 25 basis points, the 2 years higher by 7 basis points. We're back through 430. Bob Michael at JP Morgan's had some time to go over the statement, to go over the projections and the market reaction. What do you make of this one?
Well, I think they have an incredible sense of self-awareness that the economy looks great. The fourth quarter is going to come in around 4%. You've got unemployment at 4.2%. They'll take the side of it that says that's a pretty good level to be at. Inflation's a little bit above their target. What's the rush to keep cutting rates? Let's just back up a little bit. I think also they do have to listen to what's being talked about at Mar-a-Lago. And there is a lot being talked about. Not any of it is going to be disinflationary or a headwind to growth. And they have to begin to model that in. I actually think they did the right thing. I'm pleasantly surprised they went to 2 cuts next year instead of 3. We'll see what happens.
I mean, do they model in, does the Trump administration model in his behavior, his statements on strong dollar that we saw, I don't know, 8 years ago, whatever the math is? Or is there going to be a different discussion about the efficacy of a strong dollar for President Trump? He's going to demand a weak dollar. We got to have exports up, or is there new behavior?
I think that's something we're just going to have to wait and see. I think there's still a view that the exceptionalism of the dollar is another one of these things that's potentially overinvested in. And suddenly, if you see policies coming out of the administration on tariffs that aren't as severe as expected, then you're going to see a lot of the foreign economies, a lot of the currencies and bond markets start to appreciate a bit.
Do you think that it was a mistake, and essentially this is the Fed walking back what Fed Chair Powell said about we will not welcome any further weakening in the labor market?
I think there's some of that, and I think they looked at the totality of the data. I started by saying when they look at everything, it's the perfect soft landing. They're looking for a resting spot. They don't think it's 3 or 4 rate cuts away. They think it's somewhere around 2 more rate cuts away.
Do you think that it's good that there's more dissent now at a time when there is so much dissent and disagreement just about understanding where we are currently?
I love it. I think it's ideal. You heard the conversation with Ellen. She's sitting there looking at things are about as perfect as you can get them. I try to point out housing, and she smacks it away. And I think that's what you're getting at the Fed, which is, you know what? Inflation's a little higher than we want. Growth is a little bit firmer than we thought. The labor market looks pretty healthy. And by the way, has anyone talked about holiday sales? The consumers looked pretty good. What are we doing cutting rates further?
I look at this, John, and of all the things moving across the Bloomberg Launchpad, Canadian dollar is extraordinary. We're not near a 144, but it's a jump condition, unlike others which are just pushing up as well.
They've got their own Trudeau-shaped problems, Tom, and Europe's got their own problems too. Euro dollar right now breaking down to 104.20, just about holding on now to a 104 handle. There's one question I've got for you, Bob. It's a forecast we haven't talked about. The longer run dot, it is inched up by like that much, from 2.9 to 3. Is there not a bigger realization going on at the committee that needs to come up a whole lot more? Why is this taking so long to draw that conclusion?
Yeah, I think the realization is setting in, and I think having a dissenter on board is going to help drive that conversation. But if you step back and think where 3% is relative to a few years ago, that does seem pretty high. We had negative real Fed funds rates for a long period of time. The very first dot back in 2012 was 4.25%. Now we're right about that 4.25%. Why not just sit there and say, we can get to around 2% inflation. About 1% of a real Fed funds rate is about the right level of pressure. I still think it's going higher.
The chairman talked about a recalibration. We've had 3 meetings, 100 basis points of cuts across 3 meetings. Was that the recalibration? Have we had it now?
I think that's some of it. I think
you think that's only part of it?
Yeah, I think that's only part of it. It just takes a weak labor print over the next month or so. It takes a surprise to the downside in core PCE. One of those things to remind the Fed that this level of rates with a 4 handle in this economy that's come from 0 interest rates is still somewhat restrictive, and there's more work to do.
If you are just joining us, welcome to the program. 10 minutes ago, a 25 basis point reduction from the Federal Reserve. A sprinkle of dissent, but that's not where the headlines are. The headlines are in the summary of economic projections, released alongside the statement from the Federal Reserve, where they increased their forecast for GDP for 25. They took down their unemployment rate forecast. They pushed up their forecast for PCE, and they did this with interest rates, projecting rates would drop only to 390, when previously they were looking for 340. So the Federal Reserve essentially, for the median dot, has gone from projecting 4 cuts in 2025 to just 2. Off the back of that, in the bond market, yields are higher, the dollar's stronger, and equities are rolling over. On the S&P 500, we are down by 0.6%. To weigh in on this, Diane Swonk of KPMG joins us now. Diane, you've had some time to pore over all of this. Let's start with those projections. Was that in line with what you were looking for?
Actually, it is, and I'm glad to see it. I thought that the Fed was going to, if they were going to do a quarter point, which was already priced into the market, that they had to scale back dramatically, at least by half, their forecast for rate cuts next year, which is what they did. And the disagreement within the committee is exactly what you would expect. There's a lot of debate right now about how close are we actually to neutral. And in fact, you know, the new Cleveland Fed president was one of the ones that said we may be closer than you think. So it's not so surprising that she cast a dissent, even though it's her first meeting. It's also her last meeting to vote before we see Austin Goolsbee roll back onto the committee in January as a voting member. I think it's not surprising at all that there were 3 participants at the meeting that also agreed that they don't want so many rate cuts next year. The economy, they can do it without front-running any policies. Right now, the economy has come in much stronger than they expected. There's been upward revisions to both employment and inflation's come in hotter, and the consumer is atlas to the U.S. economy and the world at this point in time, and that's important. I think it's also going to be really important to see in the discussion and in the minutes to this how much they talked about that consumer sentiment number that showed people buying ahead of price hikes and that hoarding activity, which suggests that perhaps inflation expectations are not as well anchored as they thought and have become a bit more moored in the post-pandemic economy.
Diana, Illinois, your Illinois, is the 5th largest state economy. It would be the 18th largest economy if it was a country in the world. And yet we perceive Illinois not flat on its back, but a much more diversified, struggling state. What do you see out there about the 2 Americas that you would tell Chairman Powell?
Well, you know, I don't need to tell Chairman Powell anything because he spends a lot of time looking at both Americas. I think people don't realize how much time he spends talking to people who are trying to upskill themselves and get out of being paid by the government and get training, especially single women with children. I know how much he spends time. He doesn't want to spend time just talking to executives when he goes out to all of his regional visits at the Fed. He actually asks to see the underbelly, to see where people are struggling, what's really going on. I think what's important, I mean, I think about this in my own situation. My son, when I asked him what he wanted for Christmas, he asked me to donate to the homeless. And the working homeless are a real problem. And I think that is one of the issues that we're struggling with. And interest rates alone coming down are not going to change the supply of housing. That once was a single lever. We know that affordability has been bid up by a whole host of factors, including scarcity of labor and and these recent disasters that we've seen, which are pushing up the costs of actually construction.
Because of this fragility, and Bob, I'm curious your thoughts. Some people are saying that essentially this is a hawkish tone, but this still is a Fed with a pretty low bar to cut again. That is the comment from Neil Dutta as he looks underneath the hood of some of the employment markets that Diane was talking about. Do you agree?
I think the bar was low. It got a lot higher because they're telling us they're rethinking how many cuts they have to do. And certainly by the time they meet again at the end of January, they're going to hear a lot more from the administration. And it's going to be the administration, not the incoming administration. And they're clearly going to have to model that and weigh that. So I don't think there's a pretty low bar here. I think it's gotten higher.
I'm really pleased you brought up Neil Dutta's note. If you go to the bottom of this note, Neil from Renmac, of course, there's an interesting line here on the incoming administration. There is plenty of speculation of what the Trump administration will do, but they have to actually walk through the door. The Fed ought to focus on the here and now. The risk is now that the economy slows and the Fed is passively tightening by doing nothing. And here's the kicker, I think the punchline. Curious that the Fed was about to cut 100 basis points and then all of a sudden stops as Trump walks through the door. Diane, how much of these moves, the change to the forecast that we're seeing, are about the incoming data since September, and how much of it is about expected changes to policy that will shape that data in the years to come?
Well, we do know that with the continuing resolution that they're talking about a fairly large increase in bailout funds for the affected states from the 2 hurricanes. That will boost growth at the beginning of the year, and it is inflationary at the same time. So that is sort of already baked into the cake. Are they doing scenarios? Of course they are, but they can couch, certainly, I think you're going to see Powell couch very much and be very cautious to say they're not front-running any policy. They did cut at this meeting. If they were front-running policy, they wouldn't have cut at this meeting. And I think that's what Powell wanted to say, even with a dissent, with this hawkish tone. This is sort of the perfect way for him to say, we're doing our job, we're looking at the data, it's coming in stronger, the economy's solid, and it justifies higher rates. Now, you always worry about what's going to break going forward. The administration coming in, they will have more information on it, but even tariffs take quite a while to kick in. They don't kick in overnight. And I think people forget about that, and we don't know what not only will the tariffs completely look like, we have ideas and we can model out scenarios, but retaliation will be designed to disrupt supply chains. That's very important because when you're thinking about it that way, that is inflationary. And we're in a much more fragile supply chain environment, which we've already seen. Vehicle prices have already gone up again just in response to the damages and the buying ahead of additional price hikes due to 2 monster hurricanes. So we're in a situation where we have much more fragile supply chains with the embers of inflation still smoldering. That's just not a situation you want to add fuel to the fire on. You want to keep the lid on inflation, and I think the Fed is still hoping to hit that soft landing. But a soft landing, really, they will not declare victory, and this will not be Chairman Powell that we saw a year ago, who was pretty jubilant a year ago when we were sitting in this exact spot. I think you're going to see a Chairman Powell that is cautious, optimistic about the economy, talking about the strength of the economy. That's why they're doing what they're doing. That's why the outlook looks like it is, not front-running policy.
But Michael, I got a 10-year yield moving, the real yield. The real yield was a 2.05, 2.02. All of a sudden, I'm popping 4 basis points, rounded up out to 2.13%. What does that signal to your bond market? What does that signal to business just to see the real yield buttressed up right against recent highs back 6 months?
It tells me that investors might have been tilted the wrong way coming into the FOMC decision, and they're unwinding some of that. We'll see where it closes. I'm pretty optimistic things will settle down. I think Diane said it correctly, that this is still a Fed that cut rates in front of incoming policies. So they must see something in the improvement in inflation that they like, and they must see something in the labor market that they want to make sure doesn't metastasize.
We'll find out more in about 11 minutes' time when this news conference starts. A special thanks to Diane Swank of KPMG. I want to draw your attention to what's developing in the FX market and elsewhere. So we'll start in the bond market. Just a flavour of that. Yields up on the front end by 7 basis points. The 2-year back through 430. If you take that move, just push it through foreign exchange. What do you expect? Big moves in G10. The dollar stronger against absolutely everything against the majors in G10. Beyond that in EM, Tom, 2% move against Brazil.
2 against a -6. Well, but then
that's another 2%.
Each of them, yeah, but each of them are idiosyncratic.
On top of the 20 so far this year.
Yes, you got Turkish lira popping through 35 today finally, but they're each a different story. But as Damien Sassauer says, who's expert on this, it is a flat-out 6% depreciation in EM currencies. And John, I'm looking at the drawdown in the Standard & Poor's 500. I'm not using the Dow here. And the SPX we have a drawdown now a negative 1.5%. There's carnage out there.
Session low, we're down about 0.7% on the session on the S&P. Matt Lazzetti of Deutsche Bank joined us now. And we teased this one up, Matt, a little bit earlier in the program. We said Matt Lazzetti is looking for one more cut, said it was a close call for December, and then ultimately, you think they're done for 2025. Matt, are they getting closer to your world?
Well, yeah, I mean, you have to say that the dots move closer to that world today. I think really importantly within the SCP, obviously a lot of focus on the dot plot, but what drove that was this big upward assessment in inflation. They moved up their core PC inflation forecast to 2.5% next year. That's closer to our own view. They moved up their core PC inflation forecast for 2.2% in 2026. Really it takes till 2027 really to get back to their inflation target of 2%. And then there was a big reassessment of the risk assessment around both the labor market and inflation. Risks to the upside of inflation, everybody kind of anticipates a move back in that direction, and there are much more balanced risks to the labor market. So it's a kind of an SCP from a forecast perspective and from a risk assessment perspective that looks a lot more like it did in June than September.
Matt, how much do you think this really is stemming from the data that we've gotten of late versus just a promised change in policies next year? In other words, is this, as Neil Dutta says, that they cut by 100 basis points and then Trump walked in the door?
I think a lot of this is just the incoming data that we've seen. They marked up their growth forecast as everybody else has by about 50 basis points since the September meeting. They marked up their inflation forecast, just given the incoming data, by 20 basis points since the September meeting. Marked down their labor market forecast by 20 basis since the September meeting. I think the data since the September meeting confirmed a few things. One, growth is robust. Two, the downside risks to the labor market and consumer are less than they were 3 months ago. And three, there are risks that inflation is just stickier than many anticipated. Just to put into some context, core PC ended last year at 3%. It's likely to end this year at 2.8 or 2.9%. That's very little progress over the course of this year, and they basis points despite that.
Matt, Jason Furman just publishes up at Harvard teaching Act 10. His first sentence, Matt, is simple. I don't know why the Fed cut. Matt Lazzetti, why did the Fed cut?
I think it's a great question, and as was kind of discussed, we thought that there was a lot of good reasons not to cut. I think when Chair Powell is asked this question, it's going to be a difficult one for him. But the way that I think he'll frame it is, they still believe that they were restrictive, and we still believe that they are as well, and that even with a 25 basis point cut, they maintain that level of restriction, and that they're still kind of being able to balance the risks assessment from a labor market inflation perspective at this point in time. So I think that'll be the argument at this point. That said, I think the signal from them is that they're not just on this regular cadence of rate cuts. They're not just kind of on a path, a smooth path down to a neutral rate that is kind of uncertain. That it does look like they are going to be pausing for a bit longer here, given their baseline forecast for the data. And that's in line with our own expectations, that the data flow, we think, over the coming months and then coming quarters will just not be consistent with dialing back more restraint.
Tom, I thought that was a great question, and I'd like Bob's answer, because honestly, I think that really is a key question, and it's going to be very difficult for this Fed chair to really answer. If you actually are upgrading your expectation for core PCE, why did you cut it all this meeting?
Yeah, and so Matt may eventually be right that this was the last one. As he was talking, I was thinking, boy, this is really reminiscent of 1995 when they had hike rates from 3 to 6%. Everyone thought they'd have to cut rates to 4. They did 75 basis points. That was it, 5 1/4, and then they came back shortly thereafter, starting to hike rates. You do look around, and you do see that actually the economy's doing pretty well. Now, there are things below the surface in the labor market they have to be concerned about. There is a 0.9% increase in the unemployment rate. You've never had that without a recession. We look at job gains and look at the 6-month moving average, 108,000. Haven't seen that since 2010. So why not continue to take a little pressure off of businesses and households?
Given everything we've learned in the last 24 minutes, does it make you more or less comfortable embracing risk this afternoon?
It makes me more comfortable. I think the Fed sees what we see, which is, hey, this is a pretty good economy. We'll see what policies look like. Let's find a place to rest for a bit. We're not going to break anything. And it could be with a couple more rate cuts, and that's it. Matt could be right. It could be here. We'll find that out by March.
Matt Lazzetti, what's the elasticity here? The Atlanta GDP statistic is 3.1%. Can this suddenly save Jerome Powell? Can we get a suddenly slower economy? Or do you really have to glide out to, say, middle of next year?
Look, the slower economy is something that, we in consensus have been expecting for the past several years. It just has not come at all. You see the past several quarters, 2.8% growth in Q3. As you mentioned, Q4 tracking at above 3% at this point in time. Our own growth forecast is for 2.5% growth next year, but that's a deceleration relative to where we are. Financial conditions are easy. Credit conditions have eased. Sentiment has improved. So I do think that this economy has substantial momentum behind it, and I think can give you strong growth outcomes. One thing I'm a little bit surprised about is actually their potential growth estimate remained at 1.8%. They've been talking so much about productivity growth, the supply side of the economy. I thought that would begin to manifest in a higher potential growth rate in their forecasts. Didn't happen today, but maybe that's in the coming quarters.
Matt, what would you want to ask Jay Powell at a time when everyone's going to try to get him to comment on Trump policies and everyone's going to try to understand just how high the bar is to cut again?
Yeah, so I think, I was going to ask about kind of the level of restriction if they had 3 cuts baked in. But I think it's more about understanding how they're thinking about a few things in the labor market. Bob mentioned, some weakness in the labor market. I'd be interested in whether or not the rise in the unemployment today, they would view similarly to the rise through the summer. I think there's many reasons for them not to. Payroll gains are stronger. The quits rate has moved higher. The hiring rate has stabilized a little bit. Job openings have picked up. But are they as concerned about this rise in the unemployment rate as they were during the summer? Second question, I think, is on shelter inflation. We did have this big downdraft in the latest print that went against Chair Powell, saying that it was going to be a very slow progress on this front. How are they just thinking about over the next several months? I think is an important question for them as well.
Matt, there's one big problem I've got with this decision, and it's the words the chairman used in the last news conference. We don't guess, we don't assume, we don't speculate. That inflation forecast, Matt, are we sitting here and really saying that much has changed in 2 months that warrants the upgrade to that inflation forecast of the FOMC without guessing, speculating, or assuming on what policy is going to do?
So our own inflation forecast is 2.6%. That builds in about 20 basis points from tariffs. So, they'd be a little bit more hawkish on the inflation front than we would be. Just going back to 2019, I don't think they're really building in tariff effects explicitly into the forecast as of yet. I do think that is factoring into the risk assessments that we see in the back of the SEP, where everybody kind of shifted back towards upside risks to the inflation front. But that should also make you worried to a certain extent. If their baseline is 2.5% without tariffs, it'd be even higher than that with tariffs, which are likely coming, and therefore they'd probably be taking out even a little bit more of those rate cuts that they were anticipating, which was already leaning in a hawkish direction.
No doubt you'll hear lots of questions about that about 3 minutes' time when this news conference starts. Matt, we'll let you run. Matt Lazzetti of Deutsche Bank, Neil Dutta of Renmac writes in, talked about him a few times already this afternoon. The Fed is prejudging policy. That's one view. That's Neil's view.
Yeah, and he's talking about the fact that there has been such a huge shift without some sort of massive change in the tone of the data. That I think people will disagree with. We have some people who say the data has come in a lot hotter. Nonetheless, they have a lot of things to explain in this press conference.
But Michael, are they speculating? Are they assuming? Are they guessing at the FOMC?
Do you know what? Their inflation forecast just struck me as frustration.
Frustration with what?
With the stickiness of inflation. It should be 1.9 to 2% by now. Look at how the labor market has loosened up. Look at how growth has slowed down. And here we are, still around 2.25 to 2.6%. I don't read anything into it more than that.
So basically, do you think that at this point, this is a Federal Reserve that basically really is just throwing darts at a dartboard?
I think they have to be because they don't.
Well, that's essentially what he's saying, but carry on.
They don't know what. By the way, back in 2009, they would have forecast 2.25 to 2.5 because remember they had the flexible average inflation targeting. They wanted higher inflation for a period of time, and that's what existed in '95 during the last soft landing. Now, they don't guess, speculate, but they model, and they've modeled something. Yeah, well,
I brought this up with Hollenhorst. Let me bring it up with you. It's real simple. Are they going to stay on an ex post method that they've used for 400 years, or are they actually getting out front and predicting? I don't buy it. They got to be ex post. They got to wait for GDP to crack, for unemployment to get to 5%.
Right now, they have the cover of both, don't they?
Yeah, exactly. I mean, they're just an ex post machine. That's all there is to it.
Bob Michael, this was fun. It's good to see you, sir. Almost there, almost to the holidays. After this is like kind of it for many of you I know going into year end, for us included. Physically, I've said we'll be here, but sort of psychologically, we'll be somewhere else.
Okay, you keep saying
after we wrap up this news conference.
So you want me to still come in tomorrow?
I'm going to be here. You're going to be here.
Are you going to be here? Or
TK's going to be somewhat checked out.
You're actually going to get to go off.
No, TK's not here physically either, right?
Yeah,
you're done.
I didn't take a vacation day until the Red Sox were eliminated. Okay, that's my tradition. So that got me to May 10th.
Nice.
And so thank you. So, I'm taking a couple days off. I'll be here next week to pick up the pieces.
Well, the chairman's here right now, so we should probably cross over down to Washington, D.C. and catch up with the chairman of the Federal Reserve, Jay Powell, after reducing interest rates by 25 basis points.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state and remains solid. Inflation has moved much closer to our 2% longer run goal. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. To that end, today, the Federal Open Market Committee decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by a 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.8% in the third quarter, about the same pace as in the second quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened. In contrast, activity in the housing sector has been weak. Overall, improving supply conditions have supported the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of about 2% over the next few years. In the labor market, conditions remain solid. Payroll job gains have slowed from earlier in the year, averaging 173,000 per month over the past 3 months. The unemployment rate is higher than it was a year ago, but at 4.2% in November, it has remained low. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than in 2019. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.2% at the end of this year and 4.3% over the next few years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in November, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.4% this year and 2.5% next year, somewhat higher than projected in September. Thereafter, the median projection falls to our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4.25% to 4.5%. We've been moving policy toward a more neutral setting in order to maintain the strength of the economy and the labor market while enabling further progress on inflation. With today's action, we have lowered our policy rate by a full percentage point from its peak, and our policy stance is now significantly less restrictive. We can therefore be more cautious as we consider further adjustments to our policy rate. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of next year and 3.4% at the end of 2026. These median projections are somewhat higher than in September, consistent with the firmer inflation projection. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy more quickly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. On a technical note, we lowered the offering rate on our overnight reverse repo facility to align it with the bottom of the target range for the federal funds rate, its typical configuration. Technical adjustments of this kind have no bearing on the stance of monetary policy. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Gina Smilek with the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit about why officials think it's appropriate to cut rates at all in 2025 if inflation is expected to remain firm throughout the year. And what would you expect at this point the timing might look like? Would a January cut potentially be possible, or does a pause next month seem more likely?
Well, so let me start by saying why we cut today and then move to 2025. So I would say today was a closer call, but we decided it was the right call because we thought it was the best decision to foster achievement of both of our goals: maximum employment and price stability. We see the risks as two-sided: moving too slowly and needlessly undermine economic activity in the labor market, or move too quickly and needlessly undermine our progress on inflation. So we're trying to steer between those two risks. And on balance, we decided to go ahead with a further cut, and I'll give you some details on why. Downside risks to the labor market do appear to have diminished, but the labor market is now looser than pre-pandemic, and it's clearly still cooling further, so far in a gradual and orderly way. We don't think we need further cooling in the labor market to get inflation down to 2%. Job creation is now well below the level, or certainly below the level that would hold unemployment constant. The job finding rate is low and declining, and other measures such as surveys of workers and businesses, quits, things like that, broadly show a much cooler labor market than we had in 2019. It's still quite gradually cooling. So we keep an eye on that. Inflation, we see that story as still broadly on track, and I'll tell you why. We've made a great deal of progress. 12-month core inflation, as I mentioned, through November is estimated at 2.8%, down from a high of 5.6%. But 12-month inflation has actually been moving sideways as we are lapping the very low readings of late last year. Housing services inflation actually is steadily coming down now, albeit at a slower pace than we might like, but it has now come down substantially, and it is making progress slower than hoped. And we've had recent high readings from non-market services and some bumpiness for goods. So I'll just say, so remember that we coupled this decision today with the extent and timing language in the post-meeting statement that signals that we are at or near a point at which it will be appropriate to slow the pace of further adjustments. You ask about 2025. I think that the slower pace of cuts for next year really reflects both the higher inflation readings we've had this year and the expectation that inflation will be higher. You saw in the SEP that risks and uncertainty around inflation we see as higher. Nonetheless, we see ourselves as still on track to continue to cut. I think the actual cuts that we make next year will not be because of anything we wrote down today. We're going to react to data. That's just a general sense of what the committee thinks is likely to be appropriate.
Sorry, just one quick follow-up. Why, I guess, would you make those cuts? Like, what would be the trigger to cut?
So we're to cut further after this point. I would say it this way: we've reduced our policy rate now by 100 basis points. We're significantly closer to neutral. At 4.3% and change, we believe policy is still meaningfully restrictive. But as for additional cuts, we're going to be looking for further progress on inflation, as well as continued strength in the labor market. And as long as the economy and the labor market are solid, we can be cautious about as we consider further cuts. And all of that is reflected, to your question, in the December SEP, which shows a median forecast of down 2 cuts next year compared to 4 in September.
With Reuters, and thanks for the opportunity to ask you a question. So this does seem similar to the dynamic in 2016 during the last transition to a Trump administration, where the committee saw slightly tighter policy, in part in expected anticipation of the fiscal policy stance that was seen evolving over the year. Some of it was a data mark-to-market exercise, and some of it was anticipation of fiscal. What's the split on this one? How much of this was accounting for inflation data that was coming in, and how much of it is expecting that there will be inflationary fiscal policy next year?
I'd say I'd point to 5 or 6 things, and let me start by saying that we think the economy is in a really good place, and we think policy is in a really good place. Let's remember that the economy is growing 2.5% this year, that inflation has come down by 50% from 5.6% to 2.6%. Headline inflation is 2.5% on a 12-month basis. We're actually in a really good starting place here. But since, so what's really driving the slower rate cut path? First thing is growth is stronger, right? The economy grew faster in the second half of 2024 so far than we had expected, and is expected to be above what our expectations in September next year as well. Unemployment is lower, and in the SEP you'll see that participants think that the downside risks are less and uncertainty is less. So that's more strength, right? Inflation is higher, as we talked about. Inflation's higher this year. It's also higher in the forecast next year. I'd also point out that we're closer to the neutral rate, which is another reason to be cautious about further moves. But then getting to your point, there's also there's uncertainty. Uncertainty around inflation, I pointed out, is actually higher. It's also in the case of some people, the way I would say it is this, some people did take a very preliminary step and start to incorporate highly conditional estimates of economic effects of policies into their forecast at this meeting and said so in the meeting. Some people said they didn't do so, and some people didn't say whether they did or not. So we have people making a bunch of different approaches to that. But some did identify policy uncertainty as one of the reasons for their writing down more uncertainty around inflation. The point about uncertainty is it's kind of common sense thinking that when the path is uncertain, you go a little bit slower. It's not unlike driving on a foggy night or walking into a dark room full of furniture. You just slow down, and so that may have affected some of the people. But as I said, there's a range of approaches on the committee.
If I could follow up on that, you mentioned the risk and uncertainty indexes toward the back of the document. The upside risk to inflation jumped quite substantially. The only thing really that's happened, you mentioned that the disinflationary story remains intact, yet the risk weighting has jumped to the upside. The only real thing that's happened is November 5th in the meantime. Is it fair to say that that's what's driving the higher sense of upside risk on inflation?
Actually, that's not the only thing that's happened. What's happened is that our forecasts for inflation for this year, I think, are 0.5 higher than they were in September. So you had 2 months of higher inflation in September and October. As I mentioned, November is back on track, but once again, we've had a year-end projection for inflation, and it's kind of fallen apart as we've approached the end of the year. So that is certainly a large factor in people's thinking. I can tell you that might be the single biggest factor is inflation has once again underperformed relative to expectations. It's still going to be between 2.5 and 3. It's way below where it was, but we really want to see progress on inflation as I mentioned. As we think about further cuts, we're going to be looking for progress on inflation. We have been moving sideways on 12-month inflation as the 12-month window moves. That's in part because inflation was very, very low measured in the fourth quarter of 2023. Nonetheless, as we go forward, we're going to want to be seeing further progress on bringing inflation down and keeping a solid labor market.
Chris.
Thank you, Chris Rugaber at Associated Press. Thanks for taking the question. In September 2018, the Fed staff in the Teal Book discussed a policy of looking through any new tariffs as long as there were one-time increases and inflation expectations remained anchored. Could you comment on if that analysis remains effective and any other thinking on tariffs generally that you can share?
So I do think that the September 2018 Teal Book alternative simulations are a good place to start. I happen to have brought them here with me today. I'm sure you have them too. They're a good starting point, and I would just say, it's 6 years old analysis, but nonetheless, this is still, I think, the right questions to ask. And there were 2 simulations. One was seeing through, one was not. And I'd point you. There's some language in the see-through paragraph that says, it considers situations in which it might be appropriate to see through inflation, and then names some conditions in which it might not be. In any case, this is not a question that's in front of us right now. We won't face that question. We don't know when we'll face that question. What the committee's doing now is discussing pathways and understanding, again, the ways in which tariff-driven inflation can affect, tariffs can affect inflation in the economy and how to think about that. So we've done a good bit of work, all of us have, each of us has, and it puts us in position when we finally do see what the actual policies are to make a more careful, thoughtful assessment of what might be the appropriate policy response.
Great, and just a quick follow-up. Given the recent bout of inflation that we've been through, with consumers seeing how prices can rise and businesses seeing that they can raise prices at least for some time, does that make it a little bit riskier to look through tariffs? I mean, do you feel you have to respond more quickly to inflation threats, given what we've seen in the past few years?
So the main thing is, and this is also a point in these alternative simulations, is there are just many, many factors that go into how much tariffs will even go into consumer inflation. How persistent will that be? So we just don't know really very much at all about the actual policies. So it's very premature to try to make any kind of conclusion. We don't know what will be tariffed from what countries, for how long, in what size. We don't know whether there'll be retaliatory tariffs. We don't know what the transmission of any of that will be into consumer prices. To your point as well, I wouldn't say that we know whether the last episode is or is not a good model for what happened. You pointed out we've just been through a period of high inflation. We've just gotten through that period. That's a difference. There was also quite a bit of diversion of trade away from China to other countries since that. That may have effects. I don't know. I just think we need to take our time, not rush, and make a very careful assessment, but only when we've actually seen what the policies are and how they're implemented. And we're just not at that stage. We're at the stage of doing what other forecasters are doing, which is kind of thinking about these questions, but not trying to get to definitive answers for some time.
Nick Timmeros of the Wall Street Journal. Chair Powell, to make sure I understand, participants today revised up their core PCE inflation projection for 25 so that the central tendency runs from 2.5% to 2.7%. And as Howard noted earlier, most of the committee sees the risks to those projections to the upside. So if inflation only declines next year from 2.8 to 2.5 to 2.7, what would compel the committee to be cutting in that situation?
Let me find these numbers. So we have inflation coming down, core inflation coming down to 2.5 next year. That'd be significant progress. You see a slower path. I think that does take on board that we want to see real progress, but we'd be seeing meaningful progress to get inflation down to that level. That wouldn't be all the way to 2%, but that would be better than this year. This year will be 2.8 or 2.9. That would be meaningful. We also have to think about the labor market, and while we have the labor market forecast as being in good shape, we are also mindful that it is still out there very gradually cooling, so far in an orderly, gradual way. But it's also something we need to keep our eye on.
I guess if I could follow up, if somebody looked at these projections and also the insertion of the extent and timing language in the statement, which has been used at times in the past when the committee thinks maybe it's going to be on hold for a while, and they said, gee, this looks like it could be the last rate cut for some time, would they be mistaken to infer that?
So that's not any decision that we made at all. Let me explain extent and timing. So the sense of that wording is to make clear that if the economy does evolve about as anticipated, we're at a point at which it would be appropriate to slow the pace of rate cuts. So extent, that just relates to how much further we can reduce our policy rate consistent with getting to a neutral stance. Clearly, that distance has shrunk by 100 basis points. So it's significantly smaller. So that's the extent question. And we're going to be looking for further progress on inflation as well as a strong labor market to make those cuts. Timing just suggests, again, that we're at a place where we assuming the economy develops as expected, we're at or near a level that will make it appropriate to slow the pace of adjustment. So that's what we mean by that. We're not trying to make decisions about the longer run. We're trying to make sensible policy as we go. And I just would emphasize the uncertainty, which is it's just a function of the fact that we expect significant policy changes. There's nothing really unusual about that. I think we need to see what they are and see what the effects they will have. We'll have a much clearer picture, I think, when that happens.
Michael McKee from Bloomberg Radio and Television. Even though you've cut rates by 100 basis points this year, we haven't seen much change in mortgages, auto loan rates, or credit card rates. You say you're significantly restrictive. Are you running a risk that the markets are fighting against you and the economy could be more at risk of a slowdown than you anticipate?
So the rates that you talked about are really longer run rates, and they are affected to some extent by Fed policy, but they're also affected by many other things. And longer rates have actually gone up quite a bit since September, as you well know, and those are the things that drive, for example, mortgage rates more than short-term rates do. So we look at that, but we look at all financial conditions, and then we look at what's happening in the economy. So what we see happening in the economy, again, is most forecasters have been calling for a slowdown in growth for a very long time, and it keeps not happening. So we're now well into another year of growth that looks like it might be 2.5%. Second and third quarters were right about at the same level. So the U.S. economy is just performing very, very well, substantially better than our global peer group. And there's no reason to think a downturn is any more likely than it usually is. So the outlook is pretty bright for our economy. We have to stay on task, though, and continue to have restrictive policies so that we can get inflation down to 2%. We're also going to be looking out for the labor market. We want to keep the labor market pretty close to where it is. We're pretty close to estimates of the natural rate of unemployment. Job creation is a little below the level that would keep it there, but nonetheless close. And so that's what our policy is trying to achieve.
If I could follow up by asking about your formulation for beginning rate cuts, included the phrase, we need to have confidence that inflation is moving down towards our target. Given the fact that you've raised your forecast for next year, do you have confidence, or are you uncertain about the path of inflation going forward?
So confidence was our test for raising rates, and we made look at the broader sweep. We've made just a great deal of progress. We're well into the twos in core inflation, and around 2.5 or even lower than that we have been for headline inflation. So I would say I'm confident that inflation has come down a great deal, and I'm confident in the story about why it's come down and why that portends well. And I'll tell you why. Again, you do see with housing services inflation, which is one that we've really worried about, it really has come down now quite steadily at a slower pace than we thought 2 years ago, but it's nonetheless steadily coming down as market rents start to equilibrate better with new leases that turn over, not new tenants, but new leases. Market rents is new leases. So that's happening. That process is ongoing pretty much as we expect. Goods inflation, which is another big piece of it, has returned right to the range where it was before the pandemic. Just for some months this year, it kind of moved up in a bumpy way because of used cars and things like that. But we think overall that should generally be in the range it was in. That leaves non-housing services, and market-based non-housing services are in good shape. It's non-market services, and those are services that are imputed rather than measured directly, and they don't. We think they don't really tell us much about the about tightness in the economy. They don't really reflect that. A good example is financial services, which is really done off of asset prices. And that's how that inflation works. So the overall picture, the story of why inflation should be coming down, is still intact. In particular, the labor market. Look at the labor market. It is cooler by so many measures now, modestly cooler than it was in 2019, a year when inflation was well under 2%. So it's not a source of inflationary pressures. Not to say there aren't regional and particular professions where labor is tight. But overall, you're not getting inflationary impulses of any significance from the labor market. So what's the story? The story is still just we're unwinding from these large shocks that the economy got in 2021 and 22 in, for example, housing services, and now also in insurance in particular, where costs went up, and those are now being reflected later in housing insurance. It's real inflation, but it doesn't portend persistently high inflation. So we and most other forecasters still feel that we're on track to get down to 2%. It might take another year or two from here, but I'm confident that that's the path we're on. And, our policy will do everything it can to assure that that is the case.
Colby.
Thank you. Colby Smith with the Financial Times. So the unemployment rate as of November, while still very low, is within spitting distance of the level that generated a lot of concern about the labor market over the summer in the lead up to the 50 basis point cut in September. Hiring has also narrowed to just a handful of sectors. But now the committee appears comfortable skipping cuts at upcoming meetings. So what has changed about the committee's assessment of the risks confronting the labor market? Is there just less concern now on that front, or is it just about there being more upside risk to inflation that now needs to be accounted for?
The unemployment rate is now the same as it was in July, 4.2%. It's moved up and down, but it's now the same as July. Job creation is lower than it has been, but it's been steady. It's not declining. It's steady at a level which, as I pointed out a couple of times, is actually below the level that would hold the unemployment rate constant, but it's not so far below. So you might if we have the break-even level right, and if job creation continues at that level in the establishment survey, then you would get a tenth maybe every other month kind of thing. So gradually declining. We don't have that kind of precision in this. So but you're right, though, and I read out some of the reasons. We do think the labor market is still cooling by many measures, and we're watching that closely. It's not cooling in a quick or in a way that really raises concerns. I think you pointed out participants in the FOMC really thought that the risks and uncertainty had improved relative to the labor market, and it's because things have just gotten a little bit better. It doesn't, the unemployment rate flat and things like that. Nonetheless, we're watching it closely.
If the idea, though, is that no additional kind of softening in the labor market is welcome here, what's to prevent that from happening if rates are still restrictive?
So what I said is we don't think we need further softening to get to 2% inflation. That's what I'm saying. Not that it's not welcome. We don't need it, we don't think. If you had a situation where inflation is moving around by a tenth every few months, that's, we'd have to weigh that against the fact that inflation has, in recent months, been moving sideways in the 12-month window. And so we've got to weigh them both. And at this point, for a while there, we were only really focused, mainly focused on inflation. We've now gotten to a place where the risks to the two are, we think, are broadly, roughly in balance. And so that's how we think about it.
Steve.
Mr. Chairman, I did not hear you use the word recalibration today. And I'm just wondering if the recalibration phase is over and what you might call this new phase and whether the criteria for changing rates is somehow different and higher than it was before. Thanks.
We're not renaming the phase yet, but we may get around to that. But no, I would say we are, though, in a new phase in the process, as I said. So, and that's just because we've reduced our policy rate by 100 basis points. We're significantly closer to neutral. We still think where we are is meaningfully restrictive. And I think from this point forward, it's appropriate to move cautiously and look for progress on inflation. We've done a lot to support economic activity by cutting 100 basis points, and that's a good thing. I support the decision, and I think it was the right decision to make. I think from now, we are in a place where the risks really are in balance, and we need to see progress on inflation, and that's how we're thinking about it. So it is kind of a new thing. We moved pretty quickly to get to here, and I think going forward, obviously, we're going to be moving slower, which is consistent with the SEP.
I wonder if I could follow up and ask you how much you or the committee are looking through some of the high numbers we've had in the recent inflation numbers. For example, cars being up maybe because of the hurricanes, eggs because of the avian flu, that kind of stuff, and then looking forward perhaps to housing inflation coming down as it did in the recent report.
So we always try to be careful about not throwing out the numbers we don't like. It's just an occupational hazard is to look, those high months are wrong. What about the low months? We have a very low month potentially in November. It's estimated by many to be in the mid-teens for core PCE. So that could be idiosyncratically low. We try to look at not just a couple or 3 months. We shouldn't have our position shouldn't change based on 2 or 3 months of good or bad data. We have a long string now of inflation coming down gradually over time. As I mentioned, 12-month, I think it's 12-month headlines 2.5, 12-month core is 2.8. That's way better than we were. We still have some work to do, though, is how we're looking at it, and we need policy to remain restrictive to get that work done, we think.
Neil.
Thanks, Chair. Thank you, Chair Powell. Neil Irwin from Axios. Financial markets have been very buoyant really all year. Is the committee comfortable with where financial conditions are, or do you see a risk that looseness in financial conditions could undermine progress on your inflation target?
So we do look carefully at financial conditions, of course. That's part of what we do. But, you know, we really look carefully at is the performance of our goal variables and how are we affecting the economy. So what we've seen over the course of, just take the last year, we've seen inflation, over the last couple of years, come down a lot. We've seen the labor market cool off quite a bit. That suggests that our policy is restrictive. We can also look more directly at the parts of the economy that are affected by that are interest sensitive, like particularly housing. Housing activity is very low, and that's partly significantly because of our policy. So we think our policy is working, it's transmitting, and it's having the effects on our goal variables that we would want. You know, a lot of things move financial conditions around, as you know, and we don't really control those. But I'd say we see the effects we're hoping to see on the goal variables and the places where we'd expect to see it.
So if I may, speaking of assets that have been buoyant, do you see any value or benefit in the U.S. government building a reserve of Bitcoin?
So, you know, we're not allowed to own Bitcoin. The Federal Reserve Act says what we can own, and we're not looking for a law change. That's the kind of thing for Congress to consider, but we are not looking for a law change at the Fed.
Andrew.
Happy holidays, Mr. Chairman. Thanks for taking our questions. I was wondering if you are satisfied with the way 2024 is ending, if you're confident that we've avoided the recession that forecasters were predicting as inevitable a couple years ago.
I think it's pretty clear we've avoided a recession. I think growth this year has been solid. It really has. PDFP, private domestic final purchases, which we think is the best indicator of private demand, is looking to come in around 3% this year. This is a really good number. Again, the U.S. economy has just been remarkable, and it's when in these international meetings that I attend, this has been the story, is that how well the U.S. is doing. And if you look around the world, there's just a lot of slow growth and continued struggles with inflation. I feel very good about where the economy is and the performance of the economy, and we want to keep that going.
The other thing I just wanted to ask about was the you guys have noted that the unemployment rate is still low. However, employment rates have fallen rather quickly. The prime age employment rate has fell by about 0.5% rather recently. The question, I guess, is do you think there's maybe more downside momentum in the labor market than the unemployment rate alone is signaling?
I don't think so, no. I think overall, if you look at it, prime age participation is still very high. What's going on in the labor market is that the hiring rate is low. So if you have a job, you're doing very well, and layoffs are very low, right? So people are not losing their jobs in large numbers, unusually large numbers. If you are looking for a job, though, the hiring rate is low, and that's a signal of lower demand. It has come down. So we look for signs like that, and that's clearly a sign of softening, further softening. I didn't mention it earlier, but I think you can see an ongoing gradual softening in the labor market. Again, not something we need to see to get 2% inflation. And, you know, that's part of the reason that explains why we moved ahead today with the action, with an additional cut. So, but you take a step back, the level of unemployment is very low. Again, participation is high. Wages are at a healthy and ever more sustainable level, wage growth. And so the labor market, this is a good labor market, and, you know, we want to keep it that way.
Thanks.
Amira.
Thank you, Amara Mokway from Bloomberg News. I just want to put a finer point on the labor market. Can you keep the labor market this way, in the strong position that you have described, without further cuts? In other words, do you still view the labor market as needing support to protect against a further cooling?
You know, we can't know that with any tremendous certainty. I will say that we think that our policy balances the risks. We think the risks are roughly in balance as between the two mandates, and we think the labor market is in solid shape. And when I say it's softening or cooling, it's a very gradual process. You know, job creations are meaningfully positive. Wages are, you know, if anything, still a bit above what would be sustainable if productivity were to revert to its longer run trend. If you take into account the high productivity readings we've had, then wages are already at a sustainable level relative to 2% inflation. So again, I don't want to overstate the downside in the labor market, because the downsides clearly appear to have diminished. Nonetheless, it's one of our mandate goals. And, you know, we pay close attention to it, and it's worth noting that it is still gradually cooling, gradually and in an orderly way. And you know, that's how I would characterize it, and that's why we're paying careful attention.
Elizabeth.
Thanks so much, Chair Powell. Elizabeth Schulze from ABC News. As you've noted, the Fed is now forecasting higher inflation next year. High prices are still a burden for so many households right now. Why do you think it is that inflation is proving to be more stubborn than you'd expected?
You know, it breaks down into a long answer if you want, but it just has been a little bit more stubborn. I think if you go back 2 or 3 years, many people were saying that to get this far down, we would have had to have had a deep recession and, you know, high unemployment by now. Well, that has not been the case. So, you know, the path down has actually been much better than many predicted. We've managed to have the unemployment rate remain essentially at its longer run natural rate, while inflation has come down from, you know, core PCE inflation has come down from 5.6% to 2.8% on a 12-month basis. So that's a pretty good outcome. Why hasn't it come down? One reason is that just a technical issue around the way we calculate housing services, and that process has been slower than market rents are showing up more slowly in that measure than we might have thought 2 years ago. So that's part of it. I think there are other parts of the story, but you know, what I think people are feeling right now is the effect of high prices, not high inflation. So we understand very well that prices went up by a great deal, and people really feel that. And it's prices of food and transportation and heating your home and things like that. So there's tremendous pain in that burst of inflation that was very global. This was everywhere in all the advanced economies at the same time. So now we have inflation itself is way down, but people are still feeling high prices. And that is really what people are feeling. The best we can do for them, and that's who we work for, is to get inflation back down to its target and keep it there so that people are earning, you know, big real wage increases so that their wages are going up, their compensation is going up faster than inflation year upon year upon year. And that's what will restore people's good feeling about the economy. That's what it will take, and that's what we're aiming for.
And as we look ahead to next year, what do you see as the biggest challenge to the economy under the next administration?
I feel very good about where the economy is. Honestly, I'm very optimistic about the economy, and we're in a really good place. Our policy's in a really good place. I expect another good year next year.
Edward.
Thanks, Chair Powell, for doing the questions. Edward Lawrence from Fox Business. So you say that we're closer to the neutral rate. What percent do you see and the committee believes, where is that neutral rate?
So I'll say a couple things. First of all, when we write, the thing we write down in the summary of economic projections is the longer run neutral rate, which is the neutral rate at a time when supply and demand are in balance, the full economy is in balance, and no shocks are hitting the economy. That is not where we are right now. So when we're making monetary policy at the Fed, That's not the question we're asking. So you can't do a straight read between those longer run numbers that we write down and what we think the appropriate policy should be. So basically, at any given time, various shocks are hitting the economy. And so what we're doing in real time is we're looking at our policy stance and we're looking at the way it's hitting the economy. And particularly, we look at the effects it's having as we try to move the economy toward maximum employment and price stability. And the answer can be, there are things that affect the economy that are lasting but not permanent. And the ones that are permanent are the ones that would be in our star. The ones that could be lasting but nonetheless go away over time, they could actually affect what's sort of technically the appropriate neutral stance in near term. So we're looking at that, and we don't know exactly where it is, but as I like to say, we know it by its works. And I think what we know for sure is that we're 100 basis points closer to it right now. There are many estimates of where that might be, and we know we're a lot closer to it. And I think we're in a good place, but I think from here, it's a new phase, and we're going to be, cautious about further cuts.
But